then when y'all are ready. Okay. Good morning, everyone. Welcome. We'll call the ad hoc search committee to order. And knowing the nature of this, I would entertain a motion to go into closed session to determine whether executive session is warranted under section 2541(7).
I'll make the motion.
Second. We have a motion and a second. Any questions, discussion? Not all those in favor say aye.
Aye.
Any opposed? All right, we'll close the meeting now to the public, and after they go, we can
We don't do this in the tort claim board. The simplest thing we do is have someone announce it outside the door. And then, for sure you could challenge what we do.
All right, I declare the meeting open to the public. The public may return, and any calls, recordings, and broadcasts resumed. During the closed session, the board determined that the executive session was warranted to discuss personnel matters exempt under section 2541(7)(4)(a), the transaction of business discussing personnel matters relating to the job performance, character, professional competence, or physical or mental health of a person holding a specific position. So with that, specifically for replacement of the executive director and interim measures. And I would entertain a motion to go in executive session pursuant to Mississippi Code 2541(7) for discussion with respect to personnel matters.
So moved.
We have a motion. Is there a second?
Second.
Second. Any discussion? All those in favor say aye.
Aye.
Any opposed? Motion carries. And for, well,
Yeah.
and we do have it, we do designate one invitee at least from the public, which is Senator Daniel Sparks.
Y'all gonna leave these on so it comes. Y'all just go unplug them others. Leave this on. No, okay, that's just something we need to address to be able to leave on this,
Water gets in here, there are a lot more problems than this house being flooded.
Yeah.
Yeah. Whole delta would be gone.
Yeah.
So the ad hoc search committee is back reopened to the public, and we'll resume all recordings, calls, and broadcasts. No action was taken during the executive session by the board, and we will, unless there's anything else in the open meeting from board members, we'll call the ad hoc committee meeting. But before it's adjourned, I'll just say that the ad hoc committee will continue to work, though, in the next few weeks to do its work. So, and for that, we will close the ad hoc committee meeting.
Right, now I'll call to order the Defined Contribution Committee meeting. Are there any remarks before we turn it over to Callan? Hearing none, then we'll turn it over to Callan.
Thank you, Mr. Chairman. Our representatives are here from Callan, and they'll take us through the performance of the MDC and ORP plans.
Thank you. Good morning, ladies and gentlemen. Good to see you all today. We'll start with the MDC plan. So that's in its own separate book. And we'll jump right in to page 19, if you don't mind. Everything that comes before that is largely market commentary that we'll hit in greater detail when we talk about the DB plan. But on page 19 tells us a lot of what transpired over the course of the quarter. If you focus on those two columns in the middle, investment return and net new investment, that really explains the change in the value of the plan over the 3 months to start 2026. The investment return column, kind of the most important for our discussion today, you'll see it was a mixed bag in terms of results. A lot of red, indicating a lot of unrealized losses across the majority of asset classes. It was balanced somewhat by fixed income, cash, and small cap equities, but not enough to account for a total loss of about $105 million on an unrealized basis during the quarter. In addition to that, a modest amount of cash flowed out of the plan, such that the market value declined from $2.5 billion to just shy of $2.4 billion at the end of the first quarter, largely driven by soft equity markets globally. Now, if we go to page 20, we can take a look at the performance of the funds themselves, and we'll walk you how we at Callan, working together with staff, evaluate the ongoing success of the managers. First and foremost, we do want to take a long-term view, so we're going to focus on the right side of this page, primarily the 5 and 10-year columns. And as you go down the page, what you will notice is that virtually all of the investment options in their own specific market spaces are doing well, meeting or exceeding the performance of their benchmarks, and also ranking above median of the peer group. And so we often refer to that as the opportunity cost question. If you weren't with that manager, but some other manager following a similar style, how would you have done? And fortunately here, there's a good array, a good roster of managers that are each performing well within their own segment.
Quick question. What about the PGI mid-cap? They've had a drastic fall off in the last couple of.
They have, and that was one we were going to speak to specifically. And so we'll do that right now. Under domestic equity, if you look at PGI mid-cap equity index, for the last quarter and the last year, you'll notice not only did they put up negative performance when their index was positive, but they're also ranking quite poorly in their respective peer group. So something that caught our eye has caught your staff's eye as well. This manager's been flagged for additional due diligence. Does not have enough history in the plan yet, I believe, to qualify formally for the watch list, as some of the other managers have, but has been flagged for additional monitoring and diligence. Today, what we'll tell you is what's driving the more recent underperformance is their style is out of favor with how the market is performing, right? Intentionally, They are a quality manager. They have a valuation component. Those aren't the stocks that have done well over the last year, year and a half, particularly in small and mid cap. If you think back to the start of tariffs over a year ago, what did well coming out of that environment was often highly speculative, highly momentum driven type names, things tied to crypto, biopharma, quantum computing, that type of stuff. Often called lower quality companies based on their management, balance sheet, what have you. An active manager like PGI, principal in this case, is actively avoiding those names for the long term. Over the short run, that's what's done well. And so that explains, doesn't excuse the short term mismatch in terms of what they did and what the market gave. But it's kind of an entrance for us to continue to do additional diligence. So not shying away from it, it is concerning. It hasn't yet risen to the level that we think you need to make a change immediately. So we'll continue to update you in the ensuing quarters on that manager. In fact, yeah, John just suggested if you would jump to page 44, this is a good kind of background on the longer term view. If you'll see page 44, top panel, this is a peer group distribution of their performance, but by calendar year. And so on the left side, we have the most recent quarter and the year of 2025. That's really where things went off the rails for PGI, again, given those market forces that I described. But if you go prior to that, you'll notice that their return pops considerably, exceeds the index, and oftentimes ranks top quartile, top decile against other similar managers. So that also gives us a little more confidence that this is a short-term struggle that we expect them to emerge from. They're going to stick to their guns, their strategy. And this longer-term view does help kind of confirm that a bit. So that was a great comment on that. That's one manager that is, obviously having a little more shorter term struggles. The other two we did want to talk about very quickly to you is the one just above that, Loomis Sales, large cap growth. So following a slightly different market segment. This is a manager that's on your watch list, and I believe you'll hear from Ryan Holiday in just a couple of moments on the watch list. But if we look out over the long run, what you'll notice is that this is a manager that may have missed the mark a little bit relative to its benchmark, but it's still ranking in the 13th percentile over the 5 and 10 year periods, meaning it beat 87% of other managers out there. So what's going on? If you look at the index itself, it was in the 7th percentile or the 9th percentile for the 5 and 10 years. Basically meaning that very few managers, if any, were able to effectively outperform the market. Something we've talked about in the past, right? When we think about large cap growth, it's been dominated by tech, by hyperscalers, by AI, and increasing amount of index concentration, right? And so active managers have had a hard time in that environment. So again, kind of another market factor really explaining their underperformance, much less concerning to us when we know the story with how the benchmark is constructed. And then the only other manager we'll hear about on the watch list, if you go to the international equity row and the second manager down, T row. Now, this is one that over the 5 and 10 year periods has had a more pronounced underperformance. A lot of this is coming from stock selection misfires, particularly within the Europe region, which has turned around for a number of reasons. So this is another manager that's been flagged for additional due diligence, finds itself on the watch list due to performance reasons, and will be subject to continued ongoing monitoring by staff and Callan. So aside from those few minor issues we've identified, everything else largely looks very good, particularly when you have that long-term view. We'll close on the cost side of things on page 22, page 22. And, familiar page we review almost every quarter. But the punchline is if you go down to the total fund row at the bottom, you'll see a dollar weighted average expense ratio for the MDC of 24 basis points, 0.24%, right? So on its face, very, very cost effective. When you compare that to the next column over, which is what it would cost if everything was priced at the median of the market today, it would be multiples higher. It would be, instead of 24 basis points, it would be almost 80 basis points. So multiple higher. So using the scale, the oversight of the committee, and the ongoing work of staff and Callan, remains a very cost-effective plan for participants. And that's one thing we know we can control, right? Much less so what the market's going to do, but the cost embedded in this plan. So that concludes the MDC. Any questions before we take a look at the ORP?
One question if I may, with the MDC, we're mirroring that with the new defined contribution piece in tier 5, is that correct? Didn't the board?
The investment lineup, that's right. Yeah.
Okay, so that's a little early to have those results, but will that be a separate report, separate and apart, but will it have that similar expense ratio, things of that magnitude?
Yes.
Yeah, the expense ratio is going to be exactly the same. That was one of the requirements for the funds to be included, is that they have to continue the same expense ratio that we enjoy with this plan.
And the investment options are also the same?
The investment options are the same.
Thank you.
And this may not be the part of where I need to ask this. Where are we with Roth?
Working on it. Empower is working to get the notices out to the employers on how to do it. So that's what we're in the process now, education.
And I assume the 5% on tier 5 folks, that can they elect for that to be a Roth? That has to be a deferred.
Correct.
Okay.
All right, ORP.
Okay, great. So now we'll flip the ORP, a separate book. Dive right into page 2. One way we evaluate these plans is just their differences with each other and the MDC. Now, they're structured very similarly, but as with any participant-directed plan, how the dollars are actually allocated by the individuals is going to differ. And so we'll point those out as we go through. Page 2 shows you the current state of affairs at a $2.4 billion total aggregate value, down a little bit over the course of the quarter for those same reasons impacting the MDC. But as has been the trend for many years now, TIA at over half of the overall assets remains consistent. And so we will skip the annuity fund platforms, which are closed and frozen, and just focus on the mutual fund versions. And so if you'll jump to page 10 with Corebridge, you'll see a total dip in market value of about $9 million to end the period at $460 million. In terms of how this plan is used, you'll notice domestic equity, particularly large cap equity, are the biggest holders of overall assets. And that's paired off nicely with about 20% in target maturity or target date funds and about 12% in stable value. So if you kind of keep that picture in your mind as we contrast that with Voya, a few pages ahead on 21, you'll notice there's much more equity risk embedded in this plan on behalf of the participants themselves. Over 55% of the overall assets is invested in domestic equity. Much less so in target date funds, about 11 to 12%, and 10 to 11% in stable value. And so with that heavier equity allocation, during a quarter when equities sold off, like the first quarter, you'll notice this plan dipped in market value a little more significantly than did the corporates just due to that heavier equity piece in aggregate. And then lastly, we'll talk about TIA on page 27. And this is, the polar opposite of that, right? So in terms of this equity exposure, it's about half, 22%, much less in large cap equity at about 19 to 20%. Much more allocated to target maturity or target date funds at over a quarter, right? And so when we go down to the total plan value, you'll see that on a $1.2 billion total plan, the drop in assets as a proportion of that was less significant given that it's a more diversified plan across the participant base. So despite the fact that each of these platforms is being utilized by participants a little differently, they each remain constructed, very well, right? Well diversified, offering the right amount of options and asset classes to participants, active and passive, and so forth. So we don't see anything missing today as it stands across these three plans. So yeah, we're happy to take any questions you might have about ORP.
What was the statement you made about the losses in July, and was that just a 1 month loss?
No, this was the period, January to end of March. So the first calendar quarter of 2026
Okay,
for this report.
and it was how much?
For the MDC,
Is it 104?
yeah, it was about $140 million in aggregate
But that's fine, that's the figure I'm looking for, yeah,
For-
thank you.
for the MDC.
Any other questions on MDC or ORP before we look at the watch list?
Mr. Chairman, if I may ask a ORP question, and it's not an investment question, I don't believe, but it may be the proper time. The ORP program went through some changes last year that put a cap on the match portion, with the remainder of that coming to PERS is a 9 to 9, and that was about 3 to 5 million in year one, and supposed to grow by that amount annually. I requested last year, as far as participants from all of the ORP entities, by job title. And I'm going to request that again after July 1 to see that some of the things that the legislature has done has actually been followed through with. I would bring that to the board. I know I'm a liaison, but working with staff or working with the executive director, the eligibility for that program is very specific. It's statutory and it is board regulation. When the audit people were here a few months ago that audit all of our PERS employers for accuracy, I asked specifically, when's the last time you audited ORP? And they could not tell us, or they did not know. I would like to know if that has been part of this year's audit, but after getting this past year's numbers, I will be glad to deliver that to the chairman or to whomever I need to. I do think going forward, we just need to know that the eligible people are eligible. And I will go ahead and say there were adjunct professors listed as ORP participants. I do not believe, I served as an adjunct at one point. Do not believe that's an eligibility situation, but I just want to bring that board's attention. They've had a full year. From an audit standpoint, we need to make sure that the proper contribution is going to PERS. And then if there are people that are in that system that shouldn't be in that system, I just want to bring that to the board's attention. Thank you.
Watch list?
Watch list is being brought to you as an informational piece only because we haven't brought it in a few months. Just kind of a reminder of who's on the list. I will tell you that coming up, one of the funds that are on this list are on schedule for deep review and for potential changes. Not prepared to remark much more than that right now, but just as a heads up. So unless there's we've already kind of talked about these managers quite a bit already. So unless there's any questions on this, I will conclude my remarks.
Any other business for the defined contribution committee?
You need to accept this.
No, it's just informational.
All right, then defined contribution stands adjourned.
I guess we had one other item.
Oh, I
that
see the other.
Miss Lee was going to cover.
Just two things we'd like to bring to your attention regarding the defined contribution plans. Mary Beth Dobbins-Beck, who many of you are familiar with from Empower, has been named Vice President for Government and Taft-Hartley plans. So many of you are familiar with Mary Beth. She's been our liaison anyway. She's been promoted. So Dan Morrison has departed from Empower, and Mary Beth will be over all of the government plans. Also, you have here an update on the Core Bridge and Equitable merger. So we've reported on that last meeting, but the new Core Bridge will be called Equitable. Core Bridge is one of our ORP vendors. They're merging with Core Bridge and Equitable, taking the Equitable title. And so that's just an update on that. We're going to learn more about that as the year progresses, but we do want to keep you informed.
What was Core Bridge before?
VALIC, AIG,
AIG,
Core Bridge, they've been, they've changed a lot, mostly since the recession. I think they were AIG, then they were VALIC, and then now they're Core Bridge, and they're going to be Equitable. So,
Great.
Yeah. And Mr. Higgins, or Mr. Chairman, if I could just address one of the points that was made by Mr. Sparks. Senator Sparks, we've also been inquiring about the adjunct professors, and I personally spoke with one university that has a pattern of this. It's not just in ORP, it's also in PERS. What I learned is that due to gross enrollment changes, they are working the adjunct professors full-time. So while the title might have been adjunct, the service was sufficient to be eligible for benefits. So we're still working through this. In fact, some of the universities use a different name, visiting professor, other titles, but at your university, they use the term adjunct. And so we've been working through this with them for a while to make sure that those in ORP and PERS, if you're adjunct, we think temporary, part-time, one class, maybe two, non-benefits eligible. However, under further review, we found that they are teaching enough classes to be considered full-time and eligible for benefits.
And I appreciate that. And the spreadsheet that I was delivered, although I asked by department and job title, was not. So I have flagged multiple pages with unique names for positions, and they can certainly answer for those. But being benefits eligible and ORP eligible are not the same thing. I could be PERS eligible and not be ORP eligible based on the statute and the regs. And I just want to make sure that maybe they use better terminology if they're in fact eligible, but those were kind of some things that jumped out.
Right, instructors, professors, all those things that are generally eligible for ORP. And so we're continuing to have those conversations, even about the title. There's a whole issue of title integrity in the universities and where PERS draws the line and where the universities lead that discussion. So we're continuing those conversations.
Thank you.
Now, any other business?
You ready now?
I'm ready now. Yeah.
Okay, I'm
Thank
going to
you all.
call the investment committee to order. Charles, I'll turn it over to you.
Thank you, Mr. Chair. Just a few opening remarks. Global markets have been exceptionally active this quarter with a powerful rebound in April and May, giving way to renewed volatility in June. April delivered broad-based equity surge in the S&P 500, which gained over 10%, and small caps gained over 12%, driven by strong corporate earnings and a renewed wave of enthusiasm around AI. International markets participated as well, with emerging markets up nearly 15% and semiconductor strength in Korea and Taiwan. The momentum carried into May as earnings in AI infrastructure spending pushed global equity to new highs. Late month easing of tensions in the Middle East helped pull oil back from April's spike. reducing near-term inflation pressure and stabilizing bond markets. Small caps outperformed. Both equities and fixed income posted gains despite mixed macro signals. So far in June, the tone has shifted a little bit. Inflation readings have come in a little hotter than expected. The Federal Reserve's more hawkish stance reintroduced volatility across risk assets. And we're seeing sector rotation beneath the surface with continued strength in AI beneficiaries and growth anticipation of a large pipeline in IPOs. Bond markets remain choppy as investors continue to reassess the path of policy rates. So overall, the quarter reflects a market balancing strong corporate fundamentals and AI-driven investment against persistent inflation and shifting monetary policies. So a dramatic that continues to shape both the risk appetite and poses challenges to asset allocations. So PERS, fiscal year to date, estimated investment return as of close yesterday is 17.4%. Now, markets are down, when I last checked this morning, about 1%. So it's going to be, it's going to be a little different at close tonight. But the NAV as closing yesterday was 40.5 billion. So those are my opening comments, and I'll hand over for a little deeper dive into performance over the last quarter with our representatives, Callan.
Thank you, Charles. And I'll take this again. If you all have the book with the white cover in front of you, we apologize, this is a bit out of order. The executive summary is in the back half of this book, right after a green tab. So if you can find that.
So are you doing the capital projections right now?
That's next. Right now,
Okay. Are you doing the executive summary?
yes.
Okay.
So once you find that back half section of that white cover book, we'll start on page 4. And this is the tear sheet for the trustees on just performance highlights for the period. Now, keep in mind, most of what we're talking about today is the 2 months that have passed since March 31st. And the final 2 of 3 months of your fiscal year. So it's missing June, but we'll fill in additional details aligning with what Charles said as we go through. So you can see as of end of May, PERS was at over 40 billion, and that was an increase of approximately 3.2 billion in that 2-month span from the end of the first calendar quarter. A lot of that was achieved during the 1 month of April, but May was also positive, and so it was a good recovery for the system. I believe when we checked earlier during the first quarter, the system lost approximately 400 to 500 million. And so you can see in the 2 months that ensued after, you made that up and then some in a big way. So that is how the system has grown over this relatively short period. Now, the asset allocation remained in line with its targets due to the ongoing rebalancing efforts of staff when needed. There were very modest overweight allocations to international equity and global equity. Unsurprising, when you look at the chart in the middle, those have been the asset classes that have really done the best. And we've seen some quite eye-popping numbers for some of these asset classes. If you look at global equity, fiscal year to date through May, it's up 29%. International equity over that same period is up 28%. And then U.S. equity doing quite well in its own right, but a little bit behind at just shy of 20%. So these asset classes, despite the dip in the first part of this year, are delivering very, very strong results. And if you go to the shaded orange box on the right, you can see what that has done for the overall system. Through May, we estimated a fiscal year-to-date return of 17%. We heard from Charles that, fast forward through June, it was a little higher, may have given some back over the last couple of days, but in any event, hovering around that number. So with a little more than a week left in the fiscal year, we expect to close with a very strong result. And then the bottom bullet point just talks about the longer run performance over the trailing 5, 10, and 15-year periods. PERS has delivered annualized returns of 7.7, 10.2, and 9.1. So exceeding the discount rate over those periods and the benchmark as well. Those are the high-level bullets on performance. We're going to dig in a little more detail over the coming pages, but wanted to see if there are any questions before we proceed.
Y'all can make a investment committee chairman look good. Y'all keep this up now. Okay.
We'll try our best, certainly. On page 5, we'll just take you through, the various market segments. So on page 4, that bar chart, those results, those are the PERS asset classes and how they performed. On page 5 is the market indexes. So going to give a similar flavor, but not exactly our realized results here. In some cases, we've done better. But you can see the 1 month of May, equities in the U.S., orange, up 5.1, equities outside the U.S., up 4.9. As I mentioned, if we had April on this chart, it was an even stronger month. And then if you'll come to the table on the bottom left, just to kind of bring you up to speed on how these various markets have done with the inclusion of June, the Russell 3000, so that's the broad U.S. market here, is up 15%. MSCI ACWI ex-US IMI, that's our international benchmark, is up 16%. So those two engines of growth continue to run hot. And then bonds have been much more muted, about 50 to 80 basis points positive, as yields have kind of moved around during the period. But the combination of these various diversified asset classes has resulted in the strong growth of PERS. Quickly, page 6, we'll talk about kind of the shifting performance of the various styles. So we've heard so much about growth over the last couple of years. And certainly, that has surged back over the last 2 months. If you look at the chart in the bottom right, you see that orange bar. That's the technology sector. So quickly kind of responded in a big way after the end of the quarter. That is much akin with the themes that we've seen, but what has also emerged more recently is the resurgence of value a little bit, and we do have value-oriented managers in PERS. And so you'll see over the fiscal year to date basis, in fact, large cap value is beating large cap growth, and we haven't really seen that in quite some time. So that's been a nice little bit of a change in the market. And then you'll also notice another change in the market we haven't seen in quite a while is at the bottom of the table, small and mid-cap companies. So the Russell 2000 up over 35%. So they're kind of also having their heyday over the course of the last year and contributing well as an overall group of stocks to PERS. And we come down to page 7, we'll look at the same markets, but these are outside the U.S. So international equity markets, both developed and emerging. You'll see on a fiscal year to date basis, getting really strong double-digit gains from the MSCI EFA hedged, almost 25%. And then emerging markets up over 46% on the fiscal year to date basis. So again, kind of a trend that we haven't seen play out on a consistent basis for many years, really almost going back to the GFC. And so it's nice to see these parts of PERS overall asset allocation also now performing well and contributing to return. It's not just all been dominated by the S&P 500, for example, right? We're getting more broad-based contribution. And on page 8, fixed income markets. Fiscal year to date, you'll notice much more muted returns. The benchmark we key on is the Bloomberg aggregate at the top. That's the US investment grade market. 3.5% return. So nothing, to scoff at, excuse me. It is positive, but it's a bit more muted than where yields are today might suggest. And that's as spreads have kind of come in quite a bit. Has kind of dampened some of the yield that you earned from the overall investment grade market, but still a fairly healthy return, contributing in a positive manner to PERS, and also helping offset some of that other volatility that we saw swinging from the first quarter into the second. So we'll look at PERS itself now on page 10. You can see the asset allocation visualized through the pie charts, and the table at the bottom tells you how close we are to target at the end of May. As we mentioned, those percent differences are all very tight. They're all within the ranges in your IPS, so you remain in compliance there. And the total market value we'll see on the next page 11 grew, quite strongly over the period. That investment return column black across all the asset classes. So everything was performing positively during that final stretch as we close out the fiscal year. Only modest cash outflow of about 69 million. So that really was kind of a drop in the bucket relative to the market gains that we saw during the period, ending at just shy of 40.5 billion. I think I'll skip ahead to page 14 and focus on the PERS total fund. And so if we take a look at that chart on the top left, it's something we've reviewed in the past. A really good report card for the system here. The blue dot is your realized results. The green triangle is your benchmark. And then those gray bars is the distribution of other public pension systems that are similarly sized, right? So in theory, pursue similar types of asset allocation strategies. The number of constituents in here ranges from 65 to 75, depending on how long we're talking about, okay? And so it's a good group of pensions across the country, and a relatively robust data set. And so what we like to talk about is that over the last year, you'll see PERS 8th percentile, really in that top 10th percent, beating 92% of other large pension systems based on your asset allocation. But that's 1 year. I think the much more important story is, that's not an anomaly. If you were to look at 7, 10, and 15 years, in fact, you'll notice the realized returns are equally strong and really kind of in that top 20%, approaching top 10% over the long run. And so you don't get there by hitting home runs randomly and then striking out several times. That really speaks to the consistency over time. And I'll show you what that looks like in just a moment. But so against the benchmark, doing well, adding value and outperforming, and then against peers, also doing well through that additional lens. So we think that speaks very highly to the ongoing health and success of PERS from an investment perspective. Any questions on that? I'll close on 15 and just get back to that consistency I talked about. So this chart looks at the similar information, but just breaks it out by calendar year. So this isn't even fiscal year, it's calendar year, but the point remains that over each of these periods, PERS is often ranking well, doing well, and beating its benchmark, and in many cases, its discount rate. So it's achieving all of those objectives. And that's been 7 of the last 9 full calendar years, as this chart shows. So it's not that a lot of this has been achieved in 1 or 2 years, but it's really been kind of spread out through the years over the last decade. And that's, again, owing to the diversified approach you've all adopted. So we'll close there and happy to take any questions.
Any questions from the board members? Okay,
Thank
we'll
you.
continue.
All right, let's go to the front of the book, if you will, and go to page 4. I'm going to discuss capital market assumptions, the Callan projections, and address any questions you might have. Why do we go through this exercise? Each year we come out and provide the 10-year projections that Callan generates through our capital markets group. And we give some background in terms of what is behind our projections and more importantly, by individual asset class, but also total fund. We take a look at your target allocation and based on those projections, what do we see going forward? And we're mindful of the fact that, your actuarial assumption is at 7%. So certainly that's a goal to generate returns in line or in excess of your assumed rate of return. Your actuary plays certainly a strong role. On the other side is they bring in the liability information and talk about it, but arriving at that, what Alex referred to as a discount rate, or oftentimes referred to as the actuarial assumed rate of return that you're expected to generate given your liability stream and given your contribution scheme how to fulfill those obligations. We tend to have a initial bias towards long-term projections. So we take long-term information by asset class, what the returns are, but we, again, also take into account the current environment, if you will. So, over the last 3 years, when we looked at the equity returns, you're in the area of 14%. If we went back to 1926, the S&P 500 generates a return of about 10.5%. So again, the idea here is the current market conditions. What is the impact that we see going forward, given the fact that we've been on this tear for 3+ years? We tend to be fairly conservative, better to underpromise and overdeliver. And again, our assumptions are that markets are clear and rational. And within our 10-year projections, typically we're seeing a 1 or 2 bear market environments that come into play. What do we believe in? We believe in, our projections oftentimes are not spot on, particularly when you're talking about individual asset classes, more successful on a total portfolio basis, and also the relationships between the asset classes. So the idea is, what is the purpose they serve in the allocation? Fixed income is your ballast to windward, and certainly given that you got a 7% growth projection or a target, we need to have growth within the portfolio. So your growth portion of the portfolio includes public equities, private equity, and real estate as well. Building blocks. So what are the building blocks? Well, we break it down. We take into account what are the inflation assumptions. Our inflation assumption is 2.5%. Your actuary is at 2.4%. The last 20 years, the inflationary return was about 2.5%. So we're kind of in keeping with that. There isn't a big disparity there. And you'll hear sometimes folks talk about, well, what is the real return? The real return is taking that nominal return and backing out your inflation assumption. Why is that important? Because when you hear comparative projections, what are they being compared to? Is it a difference in understanding of what the inflation projection might be, or is it the underlying asset classes? So we tend to be, in some cases, when, there are a number of studies out there, when we look at something like a Horizon study, which is a study of a compilation of consulting firms, we tend to be a little more, modestly more aggressive on the public equity projections and less so on like the private equity projections. So again, it's a difference in thoughts in terms of their estimates, but suffice to say that our projections largely are in keeping with any major consulting firm that you probably look out there that generate those types of returns. So, one other thing I should note, you'll hear things about beta and alpha. So our projections are beta oriented. In other words, they're not taking into account active management. What we're doing here for our projections is saying, what is the market giving you, which is the beta, the risk associated with the broad market and for these asset classes. And then if your managers exceed those particular points, that is gravy on top of our projections. So certainly, there are some areas of the market we think that the active management plays a greater role in excess returns, and some, for instance, large cap equities where it's more difficult to outperform the benchmark. And particularly, Alex touched on the challenges associated with growth managers in this environment where in the large cap space, you have the AI phenomenon, the concentration of a few names that makes it very tough for active managers to outperform, but also in the small and mid cap where the runners, if you will, the drivers of the small cap markets have been this low quality rally, if you will. So quality managers that are less, they tend to be more cautious. They tend to rely on steady earnings as opposed to expectations in the market that they have a particularly challenging time in this type of environment, despite how the market has performed. So as we turn to page 5, the question is, okay, what's changed in the last year? And very little. In fact, most of our projections are in line with what we projected the prior year. So cash, we see that holding at 3%. Core fixed income generating a return of 4.7%. So these are annualized numbers over the projections over the next 10 years. Public equity, broad US at 7.35% and non-US at 7.45%. So the idea here is that the US equity market has certainly had exceptional returns, a little bit frothy from a valuation perspective, a little bit more so than the non-US markets. And our private market returns are unchanged. And again, as we said, we hold the inflation at 2.5%. Turning to the slide 6, the next slide. A lot of numbers on this particular chart. And what this is showing you is asset class, the associated index, the 10-year geometric return, and geometric means simply that the compounded return. So the idea here is it's not a simple average. What you're doing is you're compounding a return, and suffice to say, anytime that there's volatility is a drag on performance. Volatility is a drag on performance. And then you have the real projected return. In other words, that's taking your 10-year geometric projection and backing out 2.5%. So that's your real return in excess of inflation. Standard deviation is the risk metric. So this is telling you, okay, how much volatility was in connection with this particular asset class or strategy based on the benchmark utilized. And then to the far right, you see the 2025 through 2034. So this was last year's projections. And you're going to see as you look across, largely the same across the board. Any questions? We've highlighted the asset classes that you invest in. Those are highlighted in orange. So let's take a look at your particular allocation. On page 7, a lot of information on this page. It's probably the most important page you're going to look at. Again, the top left, these are the broad asset classes, and we see the Mississippi PERS target. So in other words, U.S. equities, our target is 25% of the total fund, non-U.S. 20%, and global equity is a combination of both U.S. and non-U.S. So your global managers, consider them a swing manager. They can overweight U.S. or non-U.S. wherever they see the greatest value. So again, those three comprise 57% of the target. This is a little higher than many of your peers, and certainly you've been the beneficiary of that. Fixed income, 18%. This is modestly maybe 4% below a lot of your peers. So your your path, your allocation, a little more aggressive on the public equity side than your peers. Real estate and private equity, you've got a 10% allocation. And if we look across your peer group, that's at about 11%. So you're in line from a private equity standpoint in terms of a target allocation. Real estate, you're at 10%, peers at about 8-9%. And then again, your remaining infrastructure, private credit, kind of in line. Many of your peers within this group have about 6% in hedge funds, you have 0. So that's your underweight. So what does that look like from a projection standpoint? You can see that the bottom left projection with the 2026 assumption, 7.3%. And again, your assumed rate of return by the actuary, 7%. And your projected standard deviation, 13.8%. When we look at 2025 versus 2026, you see no difference. So to the top right, it's worth mentioning here that when you make an allocation and a projection, in any given year, you can have a greater disparity in the returns. But over the 10-year horizon, you see that they tend to gravitate more towards your projection level. So this is what this is telling you. First off, it's telling you, one, when we put together a portfolio for efficiency, this is your ability to come up with a particular mix. And then we run a Monte Carlo simulation, which is to take thousands of repetition with these returns and put them together. And your three variables are projected return, correlation, how these asset classes move together, and then your volatility. And as you go through this Monte Carlo simulation, you get a distribution. And again, the idea here is any single year, you can see the median is at 7.5%. Again, our 10-year projection, if you look straight across, you see that's 7.3%. So in other words, the median is the middle return, and then you have a distribution around that. And if you look at any single year, you can see the dispersion between the 25th percentile, top quartile, and the bottom quartile, which is negative 1.2. That's about 18%. If you go out 10 years and you look at it, you see that that median projection is 7.3%, which corresponds to our table on the left. And we see the dispersion between the top quartile, which is 10.3, and the 75th percentile, which is 4.5. So again, the dispersion there is 5.8%. So the idea here is that you're going to have good years, you're going to have 2022s, and then you're going to have bumper years like you've had for the last 3 years. It's not always you're going to get 7.3% across the board. And that's what the any single year versus the 10-year horizon tells you. Below that, we have what is the probability that you're going to meet that 7% projection? Well, in any given year, you got a 51.6% chance of beating that 7% hurdle. But if you look over the 10-year period, you got about a 53%. And I guess what I would caution you here, the reason behind this distribution is that it's not there's 7.3% and you don't need to worry about any other number. The idea here is that you have a distribution where you can be up, you can be down. The one thing I can probably tell you pretty certainly is it's not going to be 7.3. It's going to be a little bit more, it's going to be a little bit less. But the idea here is in these projections and this modeling is going to get you in that ballpark. Any questions on that? Because that tends to be an important feature of this particular slide. Hearing none. Okay. This is going to be the last slide I'm going to cover in the interest. We've got current market conditions on page 9, but that's starting on page 9, but that's really associated with last year's current market activities that really led to the 2026 projections. But on page 8, it's kind of an interesting slide, and this is one that was developed by Jay Klepper, who leads our capital markets group and had this published in the Wall Street Journal a few times. It's interesting because it tells you that markets change. And when you look at 1996, given the level of interest rates and the projections, to get that 7% return, you could have gotten there, you could get there by investing 94% of your portfolio in fixed income and 6% in large cap equity with a risk or a standard deviation metric of 5.8%. And then we saw the interest rates coming down significantly. Therefore, investors had to embrace more risk to, as you look at 2022, to generate that projection of 7%, you needed to take on almost 17%. And the allocations that would need to be projected to get you there was only 4% US fixed income, 13% real estate, and the rest was public and private equity. So again, the idea here is that significant difference given that interest rate environment. And since then, we've seen rates go up considerably to the point now, 2026, to generate that 7% return with an 11% risk. It starts to look more like a 60-40 portfolio where US fixed income would be 37%. So the idea here is even in 2022, when, the modeling would tell you if you wanted to get 7%, prudence would tell us otherwise, because once we did the Monte Carlo simulation and said, if you were to invest 83% in public and private equity, the downside was too severe. So again, when we were doing this modeling, the assumed rate of return may have been 7.25. We would continue to say the prudent allocation is going to give you something less than that. But ours is a 10-year projection. Actuaries are looking much farther out. So I'll take a stop there and ask if anybody's got any questions.
The only caution that you have given us is this is a 10-year projection. It's a positive projection for our fund, but we need to recognize that on average, there's 2 bear markets within that 10-year span.
1 or 2. Yeah.
1 or 2. I love the way you just hedge, John. Yeah. I think, let's run that tape back, Shelly. I want to hear what it, no. But so our last fair market was in 2022?
Yep.
Okay.
Yep.
So where does your 10 years start that we have one? Did it start right after that for our next 10 years or if you know what my question is?
Sure. The 10-year projection is looking forward. So,
Okay.
so it starts 2026.
It starts in this fiscal year.
Exactly. Yeah.
Okay.
Yeah. And it's calendar year as opposed to starting at July 1.
Okay.
Yeah.
Okay. Any other questions from board members?
Thank you very much.
Okay.
All right, Mr. Chairman, next item on the agenda is the manager watch list review. This is informational only. I will be on the next item, be talking directly more towards one of these managers. I do want to say that among the many projects that I myself and my team are involved in, we are currently reviewing how we are structuring our mid and small cap. Just as John said, markets change. Well, how you access those markets sometimes needs to change as well. So with this, we're looking at ways to, find strategies to systematically capture alpha in these 2 markets. But we want to make sure that doing this, we're upholding best practice standards, ensuring operational efficiency, and maintaining our alignment with your strategic mandate. So we've been identifying opportunities that seem to be offering greater consistency and being able to generate positive returns in these markets. These markets have been very hard for active managers to produce alpha. So,
Carl, turn that microphone towards you. I think
sorry about that, sir.
that's okay.
But we're still early on in the process. I just kind of wanted to give you a little heads up of some things that are coming.
Coming up this afternoon, we have 5 real estate managers. How many of those 5 are on this watch list?
There are 2 real estate managers that are on this watch list, UBS Trumbull Property and the JP Morgan Strategic. Both of those managers, the performance has been improving, but I am slow to remove asset managers from watch lists because I want to make sure that they've shown me that there is consistency in the improvements.
Okay. Any questions on the watch list? Okay.
All right. Mr. Chairman, the next item on the agenda is, I did a full review of our global equity portfolio, and I'm recommending to consolidate our manager structure from 4 managers to 3 managers. I'm recommending that we remove Harding Loebner and reallocating those assets to the remaining managers, LSV, Acadian, and PGIM. I believe that this, with this back test that I did, improves efficiency, it reduces redundancy, and if we had done this 3 years ago, it would have generated over $3 million in fee savings. So some of the key findings that I found is that there was significant overlap in top holdings amongst these funds. So by reducing the number of managers in this, it's not, impacting, our holdings, and it just reduces redundancy within the total portfolio. The next thing I found is that sector exposures were nearly identical when I compared a reconstituted portfolio of composite of LSV, Acadian, and PGIM, and compared those 3 portfolios against Harding Loebner. The exposure in sectors didn't change that much. So by removing Harding Loebner, it doesn't really significantly change the portfolio's risk profile at all. The
amount of funds that we're reallocating, would it be?
It would be 1/3 of the total. So we did some rebalancing last month, but you're looking at about 300 million-ish.
Okay.
Right. And then with a reconstituted composite, I went back and ran returns by removing Harding Loebner and redistributing assets equally amongst the other 3 managers. I found that having 3 managers in this place wouldn't have impaired performance at all, and in some cases it actually would have improved performance. And then the last key finding that I came up with is I went back 3 years and recalculated fees quarterly, as if we had only had 3 asset managers in this space. So taking advantage of breakpoint discounts for more assets under management for the 3 managers, we would have saved over $3 million, or about $1 million a year in fee savings. So this would have delivered structural cost savings, and will going forward with some of the new asset managers that we put in place. The fee structure there is very beneficial. So I'm asking this board, based on this information, that we proceed with the consolidation from 4 to 3 managers, removing Harding Loebner from the investment manager list and redistributing those assets to LSV, Acadian, and PGIM. I believe this action enhances efficiency, reduces redundancy, maintains diversification, and improves net returns to this plan.
Any questions of Charles about this recommendation from staff? If not, then his recommendation is on the second page of the letter to us. So I'm asking for a motion to approve this using his words at the bottom of that second page for the recommendation.
Move to approve.
Got a
Second.
motion?
Second.
Second, motion and second. Any further discussion? All those in favor say aye.
Aye.
Any opposed? That motion is approved for you, Charles.
Thank you, sir.
Yes.
All right, the next item that I have on the agenda is a value add real estate re-up, and I'd like to ask Mr. Clark come up and speak to this.
That's good right there. That'll work.
Good afternoon. This is a recommendation for a re-up with an existing manager for value add real estate. We're recommending a commitment of $75 million to TPG Angelo Gordon Realty Value Fund 12. It's a diversified value add real estate fund targeting 12 to 14%. Net IRR, 16 to 18 gross. The commitment supports PERS' long-time real estate allocation. It offsets natural runoff from maturing funds and continues successful decades-long partnership with Angelo Gordon. This will be our fifth fund with Angelo Gordon if it's approved. Fund 12 is the next installment in a proven value-add series and reflects updated strategy enhancements such as reduced office exposure, greater thematic portfolio construction, increased focus on industrial and residential assets, and alternative sectors within the real estate asset class, and also a more selective global allocation. Predecessor Fund 11 is performing as expected and is projected to achieve a 12% net IRR, validating the current approach. The recommendation is also driven by pacing needs. Several existing PERS value-add funds are harvesting, and new commitments are required to maintain the board-approved target allocation.
So what you're saying is we're getting money back from the other investments, and now we need to put 75 million back into the real estate here.
Yes, sir. It's a ladder approach where you have to continue.
I love your words, harvesting and that sort of thing, but that's so. You've heard the recommendation of staff. Any question of staff concerning this commitment of $75 million? If there's no question, then I would ask for a motion to approve the commitment of $75 million to this value-added real estate fund, TPG, Angelo Gordon Realty Value Fund 12, correct?
Yes, sir.
Okay. May I have a motion?
So moved.
Got a motion?
Second.
And a second. Any further discussion? All those in favor, say aye. Aye. Those opposed? There being none, that is approved.
Thanks, sir.
Next item is going to be, you've got a little work for us this afternoon, don't you?
Yes, sir.
The real estate manager presentation. So what time is it? We got 20 minutes. So how do you want to proceed?
If it pleases you, I'd like to have Mr. Busby come up and give us a short preview of the asset managers that are, going to be visiting with us today, and then have them come in after lunch, if that's
Is that okay with the board members?
the board.
Okay, then proceed. Bring Mr. Busby up.
And while he's coming up, I'm going to
We'll-
introduce him. He's one of our newest staff members. He comes to us way of Memphis through Millsaps. He's been a pleasure to work with so far, and I'm glad that he's part of our team. And he'll give you a run through of who's going to be visiting with us today.
Awesome. Thank you. Good afternoon. For those of y'all I have not met, as Charles, by way of introduction, my name is Clay Busby. I'm a portfolio manager for alternative investments here at PERS. Before we hear from the 6 funds presenting today, I just want to take a couple minutes and ground everybody in what core real estate actually is and why it sits at the foundation of our real estate portfolio. This context should help frame everything we're going to hear from our amazing managers. Core real estate roughly sits at 70% of PERS real estate allocation, and the target allocation represents over $2 billion split between 5 managers and 6 funds. When we're talking about core real estate, we're talking about high quality income producing properties. Think stabilized apartment communities, modern warehouses, well-leased buildings, and necessity-based retail. These are not development projects or turnaround situations. These are leased assets generating contractual rent income from day one. The funds that hold them are perpetual, open-end, diversified core equity funds, or Odyssey funds that institutional investors like us have been using for decades. About 2/3 of the return from these funds come from income, while the rest of it comes from property appreciation over time. This can vary slightly by strategy, and I'll let the managers cover that specifically. Within our real estate portfolio, there's a clear spectrum from lower to higher risk. Core real estate sits at the conservative end. You can think low leverage, stabilized cash flows, institutional quality tenants. Then as you move more towards core plus and value add and opportunistic, you take on more risk. You're taking on higher debt, renovation or lease up requirements, and developmental exposure. Our real estate program intentionally uses core as an anchor and blends in non-core strategies to pursue additional return. Core keeps the overall program from becoming purely a high-risk, high-volatility bet. Core real estate earns its place in Mississippi's portfolio for 4 main reasons. First is inflation protection. Leases reset over time, so rents and values tend to track inflation. This matters for a pension fund that needs to preserve purchasing power over many decades. Second is durable and stable income. The distributions we receive every quarter are driven by contractual lease payments, not by what the stock market does on any given day. Third, and maybe most importantly, is overall diversification benefits. Real estate historically shows low correlation to public equities and bonds, which smooths out total portfolio volatility and risk. Fourth, it anchors risk within real estate sleeve itself. Having a nice core anchor allows us room to pursue higher returning non-core strategies without taking on unconstrained risk across the board. Our current core real estate portfolio has outperformed its respective benchmark by 37 basis points, 137 basis points, and 19 basis points on a quarterly, annual, and 3-year basis, respectively. Before we bring in the managers, I'll leave you with a simple reminder. Core real estate is the income engine and risk anchor of the real estate portfolio and the total portfolio itself. With that context in mind, we can start to bring in the managers. Per usual, we'll go in alphabetical order, starting with Invesco. We have Carly Tripp and Will Reed, and then we'll bring in JP Morgan with Jeff Fox and Brian Nottage, followed by Principal, Patrick Mugen and Darren Cleese, and then TA Realty, Tom Landry and Jacob Malil. And then with UBS, we have 2 separate funds. We'll have Julie Piero and then Hussein Hassan with UBS TPF and Mario Maturo with UBS TPG.
Okay.
Any questions?
Just, do you want to talk to us any about each one of these individually to kind of give us an idea how they've been performing before they come in, or do you want to just wait and let them tell us about that?
Speak to any of that?
I mean, you've given us in our information that. I was just wondering if you wanted to speak to that.
Personally, I plan to let each individual manager talk about their performance, as I think they have much more detailed numbers and insights than I can provide. So I was personally going to leave that to them.
That's fine with me. I've read it, so I'm ready to go. We want to break for lunch now? Is that what you suggested?
If it pleases you, or we can,
No, it
continue.
pleases me to break for lunch. So the question is, board, how long would you like for lunch? It's approximately a quarter till. You want to come back at 12:30, give us 45 minutes? Then I'm going to recess the investment committee meeting now. We'll resume at 12:30 with Invesco. Are they our first group? Okay, thank you so much. We are recessed until we return.
School personnel,
That's right.
non-teaching school personnel.
Okay.
Board members reconvene.
Otherwise, we'll
We'll
spend it all.
try to head that way.
Be back. But yes, non-teaching school personnel.
We actually convene now, or
Do what now?
are we convened currently? Are we
Yeah.
back in session?
What, not yet, but
Not- okay.
as soon as they get everybody here.
I
I was
got-
just getting their attention.
Okay.
With our real estate people, turn it back over to you.
Clarification for the two real estate managers that are on the watch list, Mr. Clerk?
Okay,
Dr. McCray, you asked a question concerning the watch list, and any of the managers presenting today were going to be on there. JP Morgan Strategic Property Fund and UBS Trumbull Property Fund are both on there. But I did want to make the comment before they come in to let you know that in Q4 of 2025, Strategic Property Fund of JP Morgan was the highest performing fund in Odyssey. And UBS Trumbull Property Fund just surpassed the 3-year positive mark and has beat the Odyssey over the last 3 years. So the hope and the expectation is that they will not be on the watch list much longer. That's the hope. And they're both have corrected and doing very good, almost to the standard to be able to come off.
okay, thank you. Invesco is gonna be our first group?
Correct. Yes, sir. Carly Tripp and actually, here they are. I'm gonna let them come in. Thank you.
Okay, great. Good afternoon, everyone. I'm glad that you all are here, and welcome to the Investment Committee of PERS. We do have your handouts. If you'll just tell us what page you're on, we'll follow along, and I'll turn it over to you all to start. And you've already been talked to about how much time you have.
Timing,
There you
yes,
go.
so we will keep it
Okay.
tight. This is intimidating. I feel like I'm at like a deposition. But, so any questions you have, we'll make sure we have some time at the end. I am not going to flip the book because I'm doing just a little brief intro, and then I'll pass it to Will to refer to pages in the book and talk about the fund specifically. So thank you for your time today, and more importantly, thank you for your partnership. You guys have been, through Jason and Clay, amazing partners of the firm, and so we're really happy to be here. And I'm Carly Tripp. I'm a client portfolio manager with the firm, joined in January. Will Reed, who is a portfolio manager and knows all of the things about your investment. I thought I'd just really kick it off with a super brief overview of where we are in the commercial real estate markets today. And I'm going to keep it very, very high level. Happy to answer questions at the end, and I'm sure you'll hear a bunch about it from the other managers throughout the day as well. So right now we are 7 quarters into the recovery at this point in terms of return. So that means 7 quarters of consecutively positive returns for the overall benchmark, with the second quarter of 2026 expected to be the 8th. So that's positive. That tells us that we are beyond the trough and we are in the recovery phase at this point, all else being held equal. So with the trough from a return perspective behind us, I think that's also supported by fundamental activity as well. So fundamentals have been strong in varying cases, varying sectors, varying markets. It's very much a K-shaped recovery, but I'm going to give you a few sound bites that are to the positive and to the point that I made earlier with the trough being behind us. So office, 3 consecutive quarters of positive absorption. That's really, really great news, especially for commercial real estate owners and managers. As you know, it got completely crushed during COVID, and right now it is self-correcting with Class A office doing particularly well in coastal markets. So that is really good news. Industrial, Prologis, who is one of the largest owners of commercial real estate in the world, certainly the largest owner of industrial globally, they noted in their first quarter earnings that they had record leasing activity in the first quarter. Super positive sign. They also had same store NOI growth of 9%. Very, very strong from a relative and historical basis, outpacing inflation. That's exactly what real estate should be doing. Retail, so Kimco, largest owner of necessity retail in the US, reported record lease to economic activity in Q1. Why that stat is really important is because it's a great leading indicator for forward revenue growth. So necessity retail has been incredibly strong. Retail has been the best performer amongst the sectors in the benchmark. And so again, we would expect revenue growth, particularly in necessity retail, to continue going forward. Multifamily, really strong rental growth in coastal markets. This has very much been K-shaped based on the supply conditions within each market. As you're probably all aware, within the Sun Belt and Southeast markets, there was a little bit of overbuilding, a lot of supply over the last decade. That's being actually absorbed at a faster pace than what was expected to begin with, but still we're kind of working our way through that new supply within the Southeast, with, again, the coastal markets cyclically doing better today than the Southeast. So I say all of these positives, not because everything is rosy and shiny going forward, but because we are working out of a position of strength, depending on where you can select to invest within the markets. And I think right now the most important point in commercial real estate from a market perspective is, can the manager and fund actually access the market? Can they invest? Do they have capital to invest, or are they dealing with a redemption queue and have really locked up liquidity that they're trying to work through? If you've been able to actually access the market over the last 2 years, that vintage is going to do very well. Over the next 2 years, that vintage is going to do very well. So again, it's really structural and internal, I think, to the commercial real estate industry and less to external externalities at this point in time. So again, access is key right now, investing is key right now, and having new capital to deploy is key right now. That's how you're going to succeed going forward. I will pause there and pass it on to Will to go through the fund performance.
Right. Well, good afternoon. My name is Will Reed. I've been with Invesco for 7 years now. Daniel Kubiak, who is our lead portfolio manager, since his regrets he was unable to be here before. He enjoyed being here 2 years ago, but had some prior travel, and I'm very happy to get to meet you all and present to you today an update on your investment. We can start on page 9. Just start with a high-level strategy of the fund and our investment and where we think it fits into your fund. So the fund's been around since 2013. Again, Dan Kubiak, who started the fund, has been on the fund solely dedicated during that time. So we've had a strong, stable team in place. And during our 12-year track record here, we've outperformed the Odyssey Index by 300 basis points over that time period. And our strategy is really focusing on a complementary strategy to core Odyssey portfolios. And what I mean by that is if the Odyssey funds have traditionally been more in the gateway markets like San Francisco and LA, we took the strategy of let's go find best relative value in real estate investments in the Sunbelt markets, particularly where there is the business-friendly climate, affordability, quality of life that then brings job relocations and rent growth alongside it. So we started investing in the Sunbelt markets early on in the fund's inception. And the next part is, okay, if the core funds are more heavy in the traditional sectors like industrial, retail, office, and apartments, what's the next kind of space we can invest in where we find good relative value that might be overlooked? And today that's been largely specialty sectors. You might hear that called alternatives or extended property types, but for example, it's doctors' offices, senior housing facilities, or even manufactured housing facilities. So we believe that all this together creates a very diversified portfolio that overlays well with core Odyssey investments as well that you have. And we can go to page 11. We'll skip 10, being cognizant of your time here. The fund today is about $6.4 billion in gross asset value, diversified across 79 investments. And within that, there's about 200 buildings. So a very strong, stable portfolio across the United States. Roughly 80% is in the South and West regions. And the fund, due to its strong track record of performance and sector positioning that we have going forward, has been able to raise a lot of capital over the last 2 years. We've raised roughly $1 billion over the past 18 months, which has really benefited our fund and the forward positioning of the fund by being able to buy assets from other sellers or owners that might be needing liquidity. And we've been able to invest and take advantage of some dislocated markets there. And then it's termed a Core Plus fund just because it's not part of the Odyssey Index, but we do not have a big value add component at all. It's really core operating profiles that we have, and the fund is 93% lease. Historically, we've averaged about 4% annual NOI growth, and this year we're budgeting 6%. So all that's to say, the fundamentals in this portfolio are very strong, and we're excited. I've mentioned a lot of relative performance. I know that you all got in a few years ago, but it's nice to see that we have a path to some strong absolute returns coming for this year and going forward. Two other things I'll hit on just real quick is lastly, our balance sheet. So our loan to value is about 35%, which is at the low end of our target range, which is 35 to 45%. So we have room to increase and borrow debt if we find it accretive to go get more acquisitions. But luckily, we've been doing well on the new investor front that we do not need to do that. I turn to the next page on 12. So performance. Again, the fund's outperformed the benchmark by 300 basis points over longer time periods. Over the past year, we've outperformed the benchmark by 150 basis points. And a key point that we like to focus on is we are focused on income and dividend returns. We start there, and about a 5% average annual income return versus the benchmark of 4%. So just starting right there, getting 100 basis points of outperformance and layer on some leverage, and that 4% annual NOI growth will get you back to those 9% total returns. For this year, as of what we know today, we are forecasting to get back in kind of the 7 to 9% annual return. And then the next page we'll go to on 13, our annual performance. This is just trying to isolate kind of an annual view across cycles. So it's calendar year returns, income funds returns on the left-hand side in the blue, and then the green is the benchmark. And we're isolating by year just to show that in down markets like this rising rate environment on the right side of the page in 2022 and 2023, we've outperformed the benchmark there. So we're viewing this fund, and the market is also viewed the same way, as just a stable long-term performer across multiple market cycles. Our goal is to be a fund that is interesting to talk about, but very boring and not one to worry about for you all. So we hope that it's stable there. Flipping the next page on 14 to kind of give you a better feel for the specialty sectors and our fund strategy a little bit more. There's a lot going on this page, and it's a new slide, so apologies. I think we're still test running it a little bit here. But the fund's overweight to residential. So in the left-hand column of each chart, it shows 1Q26. That's our fund's holdings. Again, apologies, the colors are tough to read. And then we have a target bar to the right, the next bar chart showing like where we want to increase our sector. So where are we going forward? So for example, at the very top in the first one, there's a 3, and then we're showing an increase to 15. That's manufactured housing. So we have a strong belief in the performance and demand long-term of manufactured housing. Very limited supply, and it provides affordable housing, which this country has a deep shortage of, and that just leads to a strong renter demand profile and low operational risk for us. So we own the land in this situation, and we're not having to invest a lot of CapEx like you would on a commercial office building or even a high-rise apartment building in New York where you got to put a new pool or fitness gym every day. We just want to provide steady and stable growth in housing. Another specialty sector that we're in, medical outpatients I mentioned, the demand driver there is aging demographics and hospitals moving more towards doing surgeries and procedures outside the hospital where it's lower fixed costs for them as they don't have to be operating a 24-hour facility overnight. And then senior housing, another specialty sector to call out. This one benefits from, again, the aging demographics in this country and supplies at a 13-year low. So we're trying to look for ways in these specialty sectors where we really feel that they have the strongest demand tailwinds and also supply constraints that we can feel the most confident in our returns going forward relative to other sectors. That's how we viewed it. And the fund only has one office investment. That office investment is fully leased to Microsoft and Amazon for 8.5 more years. So we've had strong results there, and we just renewed Microsoft there for 10 years. So we only have one investment, but we are confident in that investment today. The next page, hit on the market. So where are we located? Again, this structure is very complementary to core Odyssey funds that are in the gateway markets. The fund's 80% in the South and West, primarily the Sunbelt regions. And the thesis is simple. It's just invest in the states that are pro-business, pro-quality of life, that lead to population growth. Follow the people, and the real estate will perform. So some of our largest markets, Phoenix, Dallas, where I sit actually in our home office there, Atlanta and Tampa, Houston, and Carly sits in Charlotte, kind of around up there. Flipping to page 18, we'll hit on balance sheet and flows and some of the deals we've closed to kind of round out our 15 minutes here. The balance sheet has been a strength for the fund. We talk about a lot as a fund team of just don't ever let the balance sheet put you in a situation where you're going to get and then backed into a corner. And so 80% of our debt is fixed rate, so we're not doing a lot of floating rate exposure at all. And maturities for the year of 2026 have been fully addressed, and a well-balanced out maturity schedule there. So we like to use our balance sheet as an advantage and not just something to hopefully rely on in the future and get lucky. On 19, coupled with the balance sheet is the investor flows. As mentioned earlier, the funds raised a little over $1 billion last year. Year to date, through the first 2 quarters, the fund's called $425 million of equity and has another $325 million in verbal and signed commitments. Just looking forward to future inflows to the fund, which will help us continue positioning the fund for outperformance and for your investment. Lastly, on page 20, this is a chart of the map and a few deals that we've closed. So we've closed $1.2 billion of investments across 20 investments at a average cap rate of 5.5 unlevered, so income return. And we believe these investments are well positioned to contribute both to current income returns and also longer term value creation. So I'll just close it on this slide here, but for all the reasons we talked about, strong capital flows, ability to invest in a very strong, which we believe, vintage year, There's been buyers on the sideline due to liquidity constraints, a strong balance sheet for forward performance as well, and the sectors where we believe there's less supply risk and stronger demand fundamentals to position us going forward for strong performance. With that, I'll open up for questions to the board, and thank you for your time.
Do we have any questions from board members or staff? Go ahead. I'm sorry, go ahead.
Matt, thank you, or Will, excuse me, thank you for that presentation. Research here recently has stated that there may be movement in the interest rates, but instead of down, it may be a pop up. When you look at the position of the fund, what defensive measures are in place or can you put in place to help kind of defend against a rising interest rate instead of a lowering of one as expected over the last few years?
Yes, and I think that's a good part of the future of forward returns is really going to be from your income return starting point and NOI growth. So it's not relying on buying maybe a standard core asset historically and hoping for cap rate compression to go down with yields. And so how we're positioned for that is we fixed 80% of the debt. So not just having to get renew floating rate debt in a year or two. And our biggest focus with the income and the fund's name of the income fund is avoiding negative leverage. And what I mean by that is just not taking unnecessary debt that would ever dilute your unlevered starting place return.
Perfect. Thank you.
Others? What would you like to share with us as your time comes to an end here?
No, I think that Will, positioned everything really well. This is a really awesome fund. The team has done a great job. The allocation to alternative or specialty sectors, I think, is unique in the open-end fund space. Their income yield at over 5% is unique in the open-end income space. So to your point, I think they're starting from a nice place of being hedged, right, against a rising interest rate environment. I would also say the rhetoric around making short-term rates higher, I'm not sure they're going to really push long-term rates. I think the market has kind of given us where those will top out. That said, if you look at commercial real estate, and as you know, Jason, there's still some stabilized multifamily pricing below where the 10-year treasury is trading today, which is nonsensical, right? From a historical perspective. However, I think that the governor there is really replacement costs. So you're really buying, in some cases, 30% discount to actual replacement costs on multifamily, which is, creating this friction, I think, in terms of where your initial starting rate is and what folks are willing to pay for properties. And, that all comes back to inflation and kind of the performance of real estate long term. So if you ask me what I have to say, I'll keep going on and on and on and on, but I'll pause there.
Well, that's okay. Will, let me ask you, coming out of the trough, as was described to us, and you've had annualized negative returns of, but even with that, you're outperforming the index. So you're turning this around. How long do you anticipate this positive stream to continue?
That's a great question. And where I think it kind of piggybacks off what Carly was saying is what really hurt our, if you talk about what's hurt our portfolios, that we've had a lot of just standard apartment communities in cities like Charlotte or in Tampa in the Southeast where the supply hit record levels when the rates were low. The forward growth now is we've seen supply come down 75% since the peak, and the renters still doing very well. And by ways of saying that we should start seeing rent growth in our portfolio, especially in the multifamily piece, really start being a strong contributor to returns, which used to be our largest positive contributor leading up until the peak of this last cycle. So there's a large piece of our fund that should still deliver that large kind of outside growth that I believe you're referring to of how high can it keep going and recovering.
you see the mobile home, what I call mobile home and you call manufactured housing, I guess. Do you see those communities beginning to blossom now? Of a collection of those homes, neighborhoods and that sort of thing?
As we've acquired 7, I think Blossom is in like returns and growth behind them. There are some headlines you'll see where managers will go in and acquire a park and increase rents 30% overnight. That is not our strategy, and we will not do that. Our strategy is really just to increase rents minimally, where we can still benefit from the return on where we're buying, and in turn you get a very happy resident that will stay long term, and you don't have the downtime.
Okay. Other questions, comments? Thank y'all for coming. Thank y'all for your hard work. Thank you for sustaining yourself through the trough, and now we're looking at good things in the future.
Yes,
Thank
sir.
you.
Thank you very much.
We're trying to get rid of manufactured housing.
That's not gonna work in the trial.
Real estate over everything else.
Good afternoon. Welcome to the PERS of Mississippi and the Investment Committee. We have your materials. So if you'll just point out to us where you are, we will follow along. And I would request that you try to stick to the timeline that's been indicated to you. We have a long afternoon, so I'm just going to turn it over to you all and let you all begin.
Perfect. So let me start quickly. Jeff Fox, JP Morgan. I've been here 26 years, run the public funds business, and I've had the pleasure of working with Mississippi PERS for over 20 years. So we want to thank you for the business. We want to thank you for the support and the relationship. It means a lot to us. I'm with Brian Nodge today. Brian's a portfolio manager on our core real estate fund, SPF. We're excited to be here because over the last few years, it's been a turnaround story for us. And quite frankly, Brian was here probably 2-3 years ago and laid out the case for where we were and what we were doing to sort of turn the ship. And I think we've done a really good job in repositioning the portfolio. And so we're excited to talk today about where we are and the outlook and how we're managing the portfolio. And obviously, please feel free to chime in. 20 minutes was our allotted time. We'll make sure we cover that in under 20. So Brian, I'll turn it over to you.
Thank you, Jeff. And I'll start on page 10. And again, thank you, everyone. We're glad that we could be here in person. And to Jeff's point, I'm happy to report the fund has continued the recovery that we started 3 years ago. So as I go through the deck, what I want to do is I'm going to lay out what we've done, what we expect for returns and liquidity, and then where we're taking the fund over the next 3 years. And I'll give you the cliff notes to what I'll say. So, I think we're in pretty good shape. So we're raising money and investing accretively. At the same time, we're continuing to provide what's turned out to be market-leading liquidity. And most importantly, it's been really disappointing real estate returns. We expect our returns to accelerate this year, and we're on path, given what we already have in the fund, to a 10% plus sort of 3-year return. And again, it's based on what's in the fund. So I'll build that up as we go along. So let's dive right to page 11 and start with returns and performance. So on the right-hand side, what we're showing is the last 2 years, so the 2 years of the real estate recovery, which has not been that great. And you can see in orange, that's the benchmarks. That's NCREIF Odyssey's cumulative returns over that period. And then there's our returns at 10.5%. So a couple things to note here. One, we've outperformed by about 440 basis points. But also, if you look at the bottom, what you can see is sector cumulative returns and overall. So this is property level appreciation. So there's only been just over 2% appreciation. So we're really in the early innings, and compared to certainly a lot of other, certainly asset types, we're in the early innings of this. And I think that we're also well positioned in terms of what I'll talk about with actually the income growth side. If you go to the left, this is what it looked like in the first quarter. So we had a 1.4 return versus 1.2 for Odyssey. And what I want you to notice is the property sector breakout on the bottom, because you'll see that the two top, you'll see that residential and industrial were basically zero. And you'll see that the second best sector was retail and the best sector was office. This would probably be surprising to a lot of people. Office is now our top performing sector, and we expect office to be our top performing sector this year and over the next 3 years. And we, given the type of office we have, we think that we're going to have a pretty unique story with that. So I mentioned that we're on track to have accelerating returns. So we think 7 to 8% for this year. We think 10% plus over the next 3 years. And there are really 4 drivers of that I'm going to expand on. The first is we have the highest asset quality in Odyssey. And that means that we have outperforming assets within sectors. That has always been SPF's calling card. What's different now is we have an accretive sector mix. So the mix of sectors that we have, and I've hinted at it a little bit in terms of what's working right now, is important for us. We also have unique sources of organic NOI growth. So that continues in retail and our alternative assets, and it's really now coming in office. And the one thing I will just say is if you kind of think about what's happening across sectors, the last 5 years, the way to win in real estate was to have as much multifamily and as much industrial as you possibly could have. That play is now ending. So multifamily and industrial are underperforming. That means a lot of small core plus funds, for instance, are struggling a little bit. What's working is high quality office, only the highest quality office, high quality large format retail, and strip retail. That's what's working. So there's been a rotation that's been very important that changes the type of fund that actually is performing, and this really plays to SPF's strengths. Go to page 12. A little bit of a brag slide, but I'm going to actually make this into something that's forward-looking. So this is what we've done over the last 2 years of the recovery. So on performance, I mentioned our cumulative performance. So we've been the top fund in the recovery period, and it has not just been because we had a big decline. This is not just a stat back story. In terms of fundraising, so over the last year, we brought in $2.4 billion. I think the most of anyone in Odyssey. I think it reflects clients feeling that we're properly valued as well as we have a good go forward story. At the same time, we've done, and we, by the way, have $211 million funded just this year. At the same time, for liquidity, over the last 2 years, we provided $5 billion in client liquidity. So that is twice our share of Odyssey. So we're about 12% of Odyssey. We provided about 25% of liquidity. In the first quarter, we did a $640 million payout. We just finalized what's going to be a $610 million payout in July. And that puts us on plan for $1.5 to $2 billion this year. And the top number is going to be dependent on, there are a couple of transactions that we're looking to close. And then finally, we've been active in acquisitions. So we provided liquidity, we performed, but we've also said it's very important for our go forward story to be acquisitive. So on the next page, this tells you what we've been doing and what we're going to do in 26. So last year, we invested $1 billion, and we invested it in two components. 2/3 of it was in alternative sectors. And so everyone's talking about alternative sectors. So the way we define it is, so these are non-traditional, non-office industrial, multifamily, warehouse. I'll talk a bit about what those are, but 2/3 of our investment last year was in those sectors. 1/3 was in something that's very unique to us, which is a build-to-suit advanced manufacturing industrial pipeline. So basically, what we have is 3 sites that are basically focused on what America actually does in manufacturing. So it's not general manufacturing. We're not making washing machines. If you think about what did Trump 1 and Biden 1 agree on, that's what we're focusing on. So we have leases to defense and aerospace, leases to chips, leases to AI. We've had 2 million square feet of leases over the last year. That is going to be $1 billion of appreciation over the next 3 years. And nobody else has that. So something that's very, very unique. This year, we'll also do $1 billion and it'll look very similar. So we're going to finish out about 1/3 of that for the construction of that build-to-suit industrial, and then we'll do the extended sectors. Okay, so I want to talk about those 4 growth drivers. So again, they are that we have asset quality, our sector mix works, we have this embedded NOI growth, and then we have this build-to-suit industrial pipeline. So these next 2 slides, there's a lot going on here. So we're on page 14. These next 2 slides talk about what's happened to our allocations. So I'm going to take you to the top right. So what this shows is basically there's a way you can break out the return of a fund. This is over the last year in a lot of ways. One way is to say, how do the assets do? Okay, so how does my office asset do versus your office asset? How does my multifamily do versus your multifamily? That's that orange on the right. That's asset selection. And this has always been SPF's calling card. We have high quality assets. I'll show you that. Our assets outperform. The challenge SPF had, this was the challenge over the past 10 years, was our sector mix did not work. So we had positive asset selection, negative sector selection. We now have positives in both. And it's a combination of a few things happening. One is we did a lot of work. So 5 years ago, 2/3 of the fund was office and retail. We are on track this year to make that 1/3 of the fund. So we did a lot of hard work in getting office and retail down. We are the fastest growing, and I'll show you in the next slide, in growing our alternatives. So we're growing our alternatives faster than anybody else. But I will also say that rotation I talked about, a lot of folks threw the baby out with the bathwater. So a lot of folks didn't say we need to reduce our office or reduce our retail. They said we don't want office and we don't want retail. Or if we want something, we'll go for something super hot like life science. And so what you've seen is that some of those over-indexing to trends, like no office, no retail, we're going to just be life science, has really hurt folks. So I think that our balanced approach has been what's effective. So we've done the hard work of getting office and retail down. What we're left with is outperforming, and others are trying to catch up, certainly in terms of their retail. And then on the next slide, we're growing our alt sector very aggressively. So this, also a lot going on this slide. So this is our extended sector exposure. So let me tell you philosophically how we define alts or extended sectors. And I know I keep saying either one. So alts, extended sectors. So what we're looking for is we look for sectors that have stable demographically driven demand. We want, importantly, low CapEx, low OpEx. That means, for instance, things like data centers, we tend to shy away from. That's a massive CapEx sector. It's not demographically driven or particularly stable. And we want high liquidity, right? We want to know there's an exit for these things. And so what that's meant is that has caused us to focus on extended residential in age-restricted housing. We've done student housing, and we've done build-to-rent single-family rentals. We've always only done build-to-rent. And there's actually the Senate is just passing a bill that will preserve build-to-rent going forward as something that institutional investors can do. So we don't buy scattered site. We don't compete with people, with moms and dads trying to buy stuff. We build in new developments. And those have all been very, very positive for us.
You've been doing that for how long?
We've been doing that since 2020. We were the first in Odyssey to do that. Then we do extended industrial. So we do truck terminals, industrial outdoor storage. We've been doing those since 2018. So we were the first to do that. And what those are, truck terminals where you kind of break down from bigger bulk to stuff ultimately that may go in an Amazon truck. And industrial outdoor storage is an interesting thing because it's sort of like a parking lot with a little building on it. So it's where you might store school buses or cranes or tiles or construction materials. The point is, these are things where no municipalities want them. So they're not overbuilt like the traditional industrial sector. And they're very locally based, right? So it's not trade flows. It's, how much tile do I want, right? And so those have turned out to be very stable, not really susceptible to the big trade headwinds that we've seen, and really not having an issue with supply. So if you think about multifamily and industrial traditional, they've been overbuilt and the demand's been weak. This part of our industrial, which is now 20% of our industrial, is really been insulated from that. What we don't do, we haven't done data centers, we don't do life science. So if you look at the bottom left, you can see that we have a smaller share of our fund in extended sectors, just under 11%. But if compared to 15% for the index, but if you take away life science and medical office, we are very close. And life science, because of what's been going on with federal funding, the NIH, that's really been put under pressure. And so we don't have that. And also, I don't think people have fully marked those down. So we marked our traditional office down 40%. Life science and portfolios that we've seen, which we have 0 of, have been marked down about 15%. So I think there's a lot of valuation risk there that we just don't have. And then you can see on the top right, we basically doubled our extended sector exposure, and our goal is to get to 20%, which we think we'll do within the next 3 years. And then finally, if you look at the bottom, in the, our extended, the assets that we have in extended sectors also outperform. So we're picking the right extended sectors, we're executing the extended sectors, and we're growing them faster than anybody. So that's our allocation story, right? That's the mix of sectors that's working for us. I just want to talk a little about the quality story. And this really shows through in office and in retail. So these are sectors where it's go big or go home. So the difference between a great office building and an average office building and a bad office building is really, really big, right? So if you looked at 270 Park, this is super crowded, right? So if you looked at New York at the best buildings, there are more people in buildings today as a share of pre-COVID. There are more people in buildings than there were pre-COVID. If you take the average office building, they're still like 25% or more lower than they were pre-COVID. The best corporations who are forcing people back are not just having people in the office, they are expanding space and they want really, really good space. So it matters how quality you are. Same thing for retail, particularly for large format retail. Malls are not still doing well. We need to get rid of a lot of malls in the country. The best malls in the country are doing really, really well. So our malls have sales of over $1,300 a square foot. And so if you look at the
What is
left,
that versus the index?
the index is about 700 square foot, right? So if you look at a Simon property, that's about where they are. So we're kind of twice the index. If you look at the left, just want to show you, this is a measure of quality. So our average office rent is 30% above the average Odyssey office rent. Our average mall is 67% above. Our average retail strip is 20% above, 30% above. And that directly translates to the right. So this is that asset selection story I talked about. Right? This is consistently been what SPF has, the asset quality. And again, the fact that we're rotating to sectors, alts on the one hand, office and retail and high quality on the other, really benefit a large fund like SPF that can in a diversified way hold large, high quality assets. And this is a real advantage relative to the last 5 or 10 years where it's been the age of the core funds with multi and industrial. Let me just end with the last two. So I talked about NOI growth. So we have organic NOI growth in retail. We're growing our retail NOI about 6%. And we have our office NOI that is about to be a double-digit NOI growth. So we did 2 million square feet of office leasing last year throughout the country, much of it on the West Coast, in California, in Silicon Valley, and San Francisco. And what we are seeing is tremendous rent growth there. And I'll just give you an example. So we have a facility called Sunnyvale Town Center, which is between Cupertino and Mountain View in Silicon Valley. So we did a lease to Databricks, which is an AI tenant. We did 4 leases over the course of the year. Between the first lease and the fourth lease, the face rents rose 8%. When you take concessions into account, the net effective rents rose 23%. We just did in San Francisco a lease that had rents that were twice what our appraisal assumptions were. So the rents were really twice as high as our appraisal assumptions. If you simply take the leasing that we have done and roll the models forward at double-digit NOI growth, this is a reason that we expect office to be a very strong performer in the next 3 years. And it's a big part of what will help us in terms of getting to that 10% return. And then the last part is the build-to-suit industrial, which is really exciting. So we have, on the one hand, that extended industrial. On the other end of our industrial is this advanced manufacturing build-to-suits. So as I talked about this is, these are tenants who the government or AI firms are writing checks to, right? And so this is really what manufacturing is working well in the country. What we have is locations that have the power, locations next to people, and the flexibility to do either warehouse or manufacturing. And this is again, something that really no one else has. And this is going to add 100 basis points to return each of the next 3 years. So those are really the four components of our return story. Our asset quality, which has always been our calling card. We fixed our allocation story in terms of sectors. We have really strong embedded NOI growth in the leasing that we've done in office and in retail. And then we have this build-to-suit industrial pipeline for advanced manufacturing that nobody else has. And so I'm going to close out on the balance sheet, looking at time. The fund, I think, is in really good shape balance sheet wise. We did a private placement last quarter for $400 million. We had the tightest spreads of any fund in Odyssey. We retired a new Nuveen loan that was $1.4 billion. We put it in the unencumbered pool. So that's what we've been doing. We've been taking a lot of fund level debt and a lot of asset level debt, moving it to the fund level. On the secured side, we did give back one asset. So a $6 million asset in Chicago, which was our last life science exposure. It didn't do anything to returns because we'd already written it down to the debt. So that's zero life science exposure now. But we are really, from the point of view of our cost of capital, we're at 4.6. That's actually 15 basis points below Odyssey. We're at 30% NAV. We're increasing our share of unencumbered debt. And our outstanding contribution queue is $330 million. So we continue to bring in new money. Our redemption queue is $1.9 billion, which is about 7.5%. That's about where the industry is. We plan to pay out $1.5 to $2 billion. I don't think that's going to exactly equal. We're going to get new requests in, but kind of giving you a sense that we're on pace to sort of maybe by the middle of next year, if the world doesn't fall apart, I think look like we're sort of putting that finally behind us. So we feel, we're well positioned. We can't control global events. We can't control capital markets. But we do think that the factors that we can control in terms of how we position the portfolio from a sector mix, from an asset quality perspective, what's unique. It really does feel, I've been on this fund for 3 years. This fund is better positioned than it's been, I think, in the last 10 years. And I think it's particularly well positioned to where this stage of the real estate recovery is going. So with that, I will take any questions, and hopefully I didn't speak too fast.
With your projection, and you keep using the word recovery more than once.
Yeah.
When does it, or how long are you going to sustain this recovery? Do you anticipate now?
Yeah. So I think we're early. And one way to think about it is that we fell 22%. We've risen 2%. So there's a lot to, you think about stocks. Stocks are way above where they were pre-COVID. Bonds, everything else has done a tremendous recovery. Real estate just hasn't had that recovery. Now, real estate doesn't have to recover, by the way, that 20%, right? So real estate can just grow its income and get a lot of that back. And it's one of the only asset sectors that has that valuation story, right? So, there are people, you could sell real estate now and buy SpaceX. It feels like that may not be a great timing. I think that's a big part of the story. I think that we have, from a relative value, from where we are in terms of, the decline, we feel really good. The second thing I would just say is that we expect to grow our income 6 to 8% over the next 3 years. And that, I think, ultimately is, if you were to say, in a world that nothing else happens, if you had 10 years, you grew NOI 6 to 8%, that would be your appreciation of 6 to 8%. It doesn't really kind of work that way. But what I would say is that we are really accelerating in terms of our NOI growth, which is the thing we can control from the 2 million square feet of office and industrial leases. That's why I think that we're moving from recovery to actually strong returns, because of that story.
Questions from board members? Yes.
Did I hear you right say that the people are coming back to the city after COVID?
Yeah.
I never thought that would happen.
Oh yeah, believe me, I wish it didn't. So I was thrilled to be at home on Zoom, and Jamie Dimon said about 3 years ago, you're all coming back 5 days a week. So what you've seen is that increasingly corporations are basically like, you have to be in 3, most are 4, and they're all basically going to go to 5. If you looked at New York City, if you're in Manhattan, you would have no idea that COVID ever happened. Manhattan is booming. And if you looked at Tuesday, Wednesday, and Thursday, offices are busier than they were pre-COVID. What's also different than pre-COVID is a lot of tenants who were not leasing or were shrinking are now expanding. Finance is expanding, law firms are expanding. That was not happening at all, and that really killed the office market. And now AI firms are expanding. So, and if you look at rents, I will tell you, so what's our best performing multifamily market in the country? San Francisco. It's growing, it's San Francisco.
Who wants to go there?
It's really improved. So look, you have a new mayor. They've really reduced crime. You've had more people in the office, and these are places where they still have great companies, and these can coexist. You can have Sunbelt offices, and you can have these things in the gateways where young people really flock to, and so that's still the case. And they're just much safer than they have been. And so we're really happy with that. If you actually looked and said, what are markets doing well right now? The reality is the Sun Belt's kind of had a lot of supply. It had a great run. It's kind of rents are kind of flat. You look at Manhattan or San Francisco or Silicon Valley, good luck getting an apartment. Right? Those are really booming.
Other questions?
So you don't anticipate Mondami having a negative effect?
I think Mondami can have many negative effects. I think that the good thing about that is that he has much less power as a mayor of New York than he can talk about. So there's a lot that the governor and the legislature has to do. He has very few things that he can do on his own, and I think that's a positive.
Good news.
Other questions or comments?
Brian, can you spend just a moment? Data centers is not something where you're initiating exposures. Well, and what's the backstory there?
Yeah, so I think that, and look, it's not saying we would never do this, and it's not saying I don't think data centers have a place. I just am not convinced that they have a place in a core fund. I think that depending on how you do it, they tend to be CapEx heavy. There's depreciation in the CapEx, the power that you need today versus the power you need 10 years from now. What does that data center end up looking like? What does the cooling look like? I think there's a lot of risk there. I still think there's a lot of question about the exits. And the reality is these things are very, very big. These are now $800 billion. They have basically 5 tenants. So literally you're leasing to 5 hyperscalers at the time. It's working really, really well right now, but I do think it sets up real vulnerabilities. And I can give you a perfect example of where we had that. If it was 2021 and you were in life science, you went, this is the best thing I've ever seen. You could not lease it fast enough. The values couldn't rise fast enough. We were building tons of supply, and everyone says it doesn't matter. We're going to lease every bit of it. And now life science has absolutely collapsed. I'm not saying that's what happens to data centers. But what I am saying is, I think from a core fund perspective, I would want to have more time to see what the exit liquidity looks like to feel comfortable doing it. And I do think that there are other things that we can do in terms of extended sectors, particularly in residential. So for instance, we're about to go into senior housing, which has relatively similar returns, but I think has a much more solid sort of demand and liquidity profile. I'd much rather play that than sort of the data center thing, notwithstanding that it hurts right now. But that's kind of how I think about it. Doesn't mean I'll think the same way 2 years from now. That's kind of how I think about it now.
Thank you.
Other questions? We thank you all for coming and sharing with us today. Brian, Jeff, appreciate y'all coming. Keep up the good work, and I want you to maintain the recovery.
Thank you.
Thank you.
Thank you.
Appreciate it. Welcome to. We do have your materials, so if you will just make sure that we know what page you're on, we will follow along. Then let's see, and you're well aware of the time constraints that we have this afternoon, so I'm going to turn it over to you all to take it away.
Yes, sir. All right. Thanks for having us. Patrick Mugen from Principal Asset Management. I was here back in October. I do have the distinction of probably being your only manager that is from Jackson, so good to be home. So I'll start there. But as you've already heard from a couple managers, we're here to talk about real estate. So I have our lead portfolio manager, Darren Kleiss, with me of our core flagship fund. Relationship goes back over 20 years. Mississippi PERS is our largest client within the fund. So as I like to say, I love all my clients, but state of Mississippi is the most important one. So with that, based on the 15 to 20 minutes that we have, let me go ahead and kick it over to Darren. Please just, if there's questions throughout, just stop us and we'll go from there.
Okay.
Thanks.
Thanks. I'm Darren Kleiss. I've been with Principal since 1992 and been working on this fund or the assets of this fund almost that entire time. So it's good to be back with you. Turning to slide 10 in the materials gives you a real high level view of where the fund sits at the end of the first quarter. And given we're deep into the second quarter where some of these numbers are getting a little bit dated, but gives you a good idea where the fund sits today. $11 billion fund. We've got 126 properties. And just a reminder, we're in the business of owning properties. We're not loaning money to other real estate investors. We're not buying stocks in real estate companies. We're actually in the business of private equity real estate ownership. Our leverage ratio is simply the amount of debt on the portfolio. And at 26%, we've got a very low cost of debt capital as well. Quick update on some investor flows. We've seen very strong investor interest in this fund. We've had a redemption queue, which is pretty common in real estate funds. We just cleared that redemption queue for the fourth time in the last year and a half last week. So we've been providing good liquidity to our investors and been able to do that through property sales as well as strong inbound investor interest from new investors. Property on the right is a shopping center that we own in North Carolina and very typical of the kind of retail that we own in this fund. The strong, dominant retail grocer as well as a small amount of shop space, and that's been a very good retail format for us. Slide 11 hits the high points of really summarizes where the fund is at. One, we've got long-term outperformance. We know that's of most importance to our investors is delivering better than market type returns. And so we've got a good track record of doing that. And a big piece of that is our growth in NOI or net operating income at the property level. And so we've got a good track record of growing our income, or you might think of that as earnings at the property level at a rate that's twice what the market has been doing. So that's been a real contributor to returns. As well as we've got the portfolio really positioned how we want it. We've got overweights to our high conviction property sectors and underweight to probably our least convicted property sector, and that's traditional office buildings. And so we're looking to add to industrial, residential, as well as alternative and retail properties. Those are the properties that we've got the highest conviction in going forward. And the portfolio is already overweight those property types. The fourth one, operational effectiveness, and that's just really executing really well at the property level. We just renewed our insurance for the upcoming year and saw an over 20% savings in our insurance cost. And so continue to operate really well at the property level. And finally there, the average cost of debt capital. As I mentioned, we've got about 26% debt on this portfolio. And we're at a rate that's about 53 basis points below kind of the other funds that invest with the same strategy that we do. And so that's been a real savings for investors of the fund. We don't, it might not sound like a lot, but 50 basis points or 53 basis points, 0.5% on $3 billion worth of debt. It's very meaningful savings for investors and contributes to positive returns. Got a few pages there. I'll skip over. I have already summarized them, but happy to go into more detail. But turning to slide 18, In addition to those main property sectors that I mentioned, we've also got some data centers that probably differentiates us from a couple of the other funds that you're hearing from today. We've got 4% allocation to data centers, and that's been really the best performing part of the portfolio. We've got 3 data center properties right now. A year ago, we had 5. We've sold a couple, and so we've seen good proceeds and investor interest from those sales, as well as with the 3 we have remaining. We've seen very strong property level performance out of those properties as well. The picture on the bottom of slide 18 is one we have leased to a company called CoreWeave in Dallas, Texas, or in the northern suburb of Dallas called Plano, Texas. In addition to those other property sectors, we've got a kind of a lead on some of the other funds on alternative sectors on slide 19. You can see in addition to the data centers I mentioned, we've got good student housing as well as some senior housing for seniors in age-restricted housing, as well as some manufactured housing. And so a couple years ago, this would not have been part of a core real estate portfolio, but with kind of traditional office, us having less conviction in that, we've got more conviction in some of these other sectors like senior housing, and looking to add to those parts of the portfolio as well. Maybe start to wrap up my remarks here on slide 22, just really highlights that leverage that I talked about. We don't have a large level of maturities coming at us. We've got a pretty evenly spaced maturity schedule, so we don't have too much debt coming due in any one year. We're not overly reliant on banks or insurance companies to refinance those property level or fund level borrowings. And so that's really left us with that very low cost of debt capital I talked about earlier. So we're on the debt that we do have in the portfolio, it carries an average interest rate of 3.98%. And so that continues to be very attractive for us. And so we've balanced really buying new properties with paying off expensive debt over the past few years. And wrapping up on slide 23, it just really summarizes our performance relative to the market or the benchmark. There's 2 kind of measures of the benchmark, the value weighted and the equal weighted ODCE. And you can see we've got outperformance over all time periods relative to the market or the benchmark. And a big reason of that is that income return that I talked about, income at the property level. You can see at the kind of the bottom half of slide 23 there, we've got that lead kind of on the benchmark's income return. So we're getting more of our return from income. And we've always held the belief that if we get more of our return from income and grow that income faster than the benchmark, it will take care of itself in terms of outperformance going forward. And so we're seeing the good results from that. We've got, and the next slide on slide 24 is a picture of one of our data center properties in Kansas City. This was the best performing property that we had in the fund last year. This is a data center that we leased to a company called Raiden, and the ultimate user of this is Microsoft. And so this is a building where they were originally going to put about $122 million into this building. The tenant was going to fund this all themselves. And last estimates we heard is they're putting in about $600 million. And so we structured that lease for where the tenant is funding a lot of those improvements, and so we as a landlord or the owners are not funding those improvements. The tenants are funding their own improvements. So this gives you an idea of the best performing property in the account.
So why did you sell some of those data centers? What was your thought processes of selling those?
Yeah, it's a good question because they're performing really well in the account right now. We're seeing the best performance there, and we were able to capture kind of a premium from some owner users. Some of the tenants wanted to buy those and be an investor in those going forward. And they were both, each of the properties that we sold were under 10 megawatts of power, and they're relatively small from where a lot of the activity in the data center space is today. And so if anything, the deals are getting bigger and bigger. And so some of these smaller facilities are probably better owned by some of these local, individual tenants and users. And so we kind of worried about some functional obsolescence with some of those by just being under 10 megawatts of power each.
And data centers are cropping up everywhere in Mississippi.
They are, yeah.
Is that good or bad?
Well, as landlords, we worry about, oversupply. Right now, there's a real shortage of power from the utilities and buildings that can accommodate this. And there's actually some growing, opposition from some in the public as well. And so we think that the strong tenant activities, it happens in every sector of real estate. You just, the stronger the fundamentals, you see a lot of new entrants come in to that space. And so that's why we're actually selling a couple of ours. We mentioned selling some of these smaller ones. We actually have, this building in Kansas City here, the tenant has a purchase option that after investing the kind of money that I mentioned in, we fully expect them to exercise that option to purchase. And so we're looking to maybe bring our data center allocation down in the fund. Yeah, data centers, the new supply is probably, it is popping up everywhere and probably put downward pressure on rental rates. Right now, the fundamentals for data centers are really good. It's actually hard to imagine it getting a lot better than it is right now. And usually when things are that good, they usually don't last. So we're just taking this as an opportunity to take some chips off the table and something that's been really good for the fund.
I was going to ask about that, your exit strategy. There's so much money going into these things. How do you, I just wonder about your exit strategy for this money that you're having to expend on the front end on the big ones now.
Yeah, and we're actually trying to encourage, and we've been very successful on this due to how strong it is for the landlords. We've structured the deals where the tenants put all their own money in. They've got access to the stock market and they can raise money. And that deal in Kansas City where the tenant is putting 600 million of their own money into it, that's not our money. We paid a leasing brokers a commission, and that's all the money that we've got going into that facility. And so we're encouraging tenants to and have structured all of our leases where the tenants are putting all the money to improve the facilities in it.
Are y'all experiencing any of the sectors that or properties that you're investing in where the people that are going to be using it retail or whatever prefer a leasing company to own it so they can expense it rather than being on their balance sheet? I mean, are y'all having to deal with that side of it as well?
Yeah, certainly accounting decisions and accounting treatment drives a lot of real estate decisions for companies. There's some favorable tax treatments through sale leasebacks that tenants can do, but generally they prefer expensing of their rent and just gives them flexibility as they shrink a footprint or kind of move operations around or something like that. And some tenants that may qualify for property tax exemption prefer to own their own as well, because if a third-party owner owns it, they have to pay property taxes and they have to pay their pro rata share. If a nonprofit or a governmental user owns it, then they don't have to pay property taxes. And so that drives a lot of decisions as well. But yeah, certainly accounting treatment drives a lot of real estate decisions and forces a lot of them into leasing.
Other questions of this group? Yes.
I was just curious, in the overall market where we're seeing wealth taxes considered, whether they're put on the ballot in California or what we're seeing in Oregon, Washington, how does that factor in if we're seeing major, whether it's a billionaire tax, you may not be affecting but just a few people who are in that category, but if their businesses start moving, are you seeing that as impact, or is that on the radar?
It's happening in a big way. It's happening quietly, but it is happening. I mean, obviously states like Texas and Florida, the Carolinas, Tennessee have benefited greatly from a lot of these things that have already been implemented and talk of more as well. And California is very soft right now, do the same things. And New York is soft. And it's not just wealth taxes. Massachusetts is talking about controlling rents right now, and that's certainly freezing investment in states like that as well. So certainly there's more noise due to tax, and it's not just wealth taxes, it's all these other taxes as well that are getting a lot of attention. And population and employment growth really inform real estate returns going forward. And some of these tax advantaged states are really seeing outsized growth.
Thank you.
Other questions?
I just had a quick question about your thesis on student housing is, where do you see the opportunities that exist as many students are attending remotely?
Yeah, the student housing business has changed a lot, not only remote, but they're spending less time on campuses. So there's a lot of headwinds, and there's the number of people turning 18 is kind of falling off a cliff. There's kind of a demographic cliff right now. So there's a couple of headwinds facing student housing. So we definitely think there'll be some winners and losers in student housing among the universities. And so we've actually lightened up a little bit on student housing over the past couple of years, just seeing some of these dynamics play out. We've got student housing at universities like Duke, University of Texas in Austin, UC Santa Barbara. So we've become more selective on where we have our student housing investments, but certainly there's been a lot of student housing properties built that aren't necessarily doing real well, but some of the, the power conferences is where we've kind of focused on, and those seem to be doing well. But it's going to be a lot more, we're going to have to be a lot more discerning in as far as where we invest in student housing. But overall, we've brought our student housing down the past couple of years.
Thank you.
Any other questions? We appreciate y'all coming and sharing with us.
It's great to be here. Thank you.
Welcome back home. I know that you're enjoying the humidity today, so
Oh, yeah.
that's a good thing for you.
Yeah, I forgot about that. Yeah.
Thank you.
Thank y'all.
Good. We're glad that you're here today and you're going to be sharing with us. I'd like for you to know that we do have your materials. We can follow along. You just let us know what page you're on, and we'll be glad to follow and read and try to find the numbers you're talking about. So the other thing is be mindful of the time limits that you've been shared with you today. So I'm going to turn it over to you all to speak to us and share with us.
Thank you very much. Well, we greatly appreciate the opportunity to be here and tell you more about the Core Property Fund. And we very much appreciate your support with the Core Property Fund as well as the Value Added Fund Series. I've been a great partner for TA Realty, and we look forward to performing for your benefit for many years and months ahead. By way of introduction, my name is Tom Landry, not the former coach of the Cowboys. I've been a partner at TA Realty for 20 years now, working in the Investor Relations Group.
And my name is Jake Malliol, partner at the firm and portfolio manager on the Core Property Fund, which we'll go into greater detail here shortly.
So very quickly, I'll give you a brief overview of the organization on page 8, if you want to turn to that particular page. TA Realty, we were established 44 years ago, 1982. All we've done since then is private real estate investing in the U.S. from core to value add on the risk paradigm. Since that time, we have transacted about $45 billion worth of assets. Currently, the firm has $20.6 billion in AUM. We're headquartered up in Boston, as you can see on the map there, and maintain offices in Ashburn, Virginia, Dallas, and 2 in California, San Francisco, and Newport Beach, California. We total about 146 total staff across the country. One of the things we're very proud about in terms of continuity of leadership and management of the firm, we've got 24 partners averaging almost 2 decades of real estate experience, and 3 decades of experience in the industry and almost 2 decades tenure at TA Realty, which lends itself to continuity and consistency of management. So with that, I'll pass it to Jake, and you can give him a sense for the core property fund.
Great. Thank you, Tom. And I'll also start on page 14. And I've got my phone here as the timer, not because I'm texting. The timer's going. So page 14, quick update on the fund summary stats. We'll kind of walk through just really 2 or 3 pages here today. But please ask questions if they come up or at the end as well. You all made your inaugural investment in this fund just about over a year ago. So kind of call it 5 full quarters. Relatively new in terms of the investment in the fund. Obviously, you all have been supporters of the firm, as Tom mentioned, by way of other fund series along the way. So relatively brief time frame in terms of the investment in this fund, but I'll just talk about what we've been up to. The fund is kind of highlighted here on page 14. It's about an $8.7 billion fund, so a good size fund, not a behemoth in the space, but not a tiny, small startup, but it's kind of a good nimble size. Being nimble allows us to try to move the fund in proactive ways. When you think about real estate, the dynamics change, the trends change, and it's important for the fund to change over time to capture those trends in terms of how people are utilizing real estate and which markets you want to be invested in, because those will change for better or worse. Leverage, which is the use of debt, you'll see here is 22.9%. So we're a little lower on the leverage side, which we'd argue is a good place to be given the volatility in the debt capital markets today. So we don't have a lot of leverage in this fund. You wouldn't expect most core funds to have a lot of leverage to begin with, but we're on the lower side, which was a portfolio decision we made given where the debt capital markets are pricing these days. So it's a kind of a safer place to be, at least in the short term. Occupancy, 93% across the fund, so it reflects a generally well-occupied portfolio. And I'll talk about capital flows real quick. We've been fortunate to have received quite a bit of capital to this fund over the last few years. Talk about the performance. It's driven because the performance of the fund has been very strong since its inception. We received about $1 billion in investor commitments over the last 5 quarters. So that's a really good front door capital raising sign of success, both US, Europe, and Asia. So capital across the globe. The other side of that is the redemption queue. And you might have heard, and certainly in the press, about these redemption queues that have built up in the space. And sometimes they're a little sticky. We're one of the few core funds, and I'm really proud of this fact, having managed this fund with a few others since the beginning, that we are operating right now with no redemption queue. We were one of the few funds to actually clear our redemption queue early being last year. Doesn't mean we weren't tested. We had about $1 billion of redemption requests hit us over the last couple of years, but we've paid it out. And one of my goals was not just to maintain outperformance of the fund compared to the Odyssey, the benchmark, but to provide the liquidity to our investors that we told them we were supposed to provide when we talked to folks on the front end and as they were underwriting the fund. And so we went through the last bunch of years, never missing a quarterly redemption payment. Even the quarters we couldn't pay the full, we paid a sizable amount, and we cleared our queue late last year. And so all of these things have put us in the path of success in terms of growth for the fund moving forward. Now, the question on how can you do these things in terms of performance, capital flows, and the redemption payments and low leverage, all of that comes down to ultimately to some level to portfolio construction, because it's like the foundation of the boat has to be strong to be able to put up the good returns, to get the new capital commitments, and to be able to pay redemptions. If the foundation's weak, that's when you start to see the cracks in the armor, right? So the portfolio construction is really, what are we built on? What have we built this fund on? So maybe with that, I'll go to slide 17 to talk about the property types and the markets that we are invested in. And I'll keep it relatively brief, but you'll see the stacked bar chart in the middle, property type diversification. Just at a high level, what property types are we overweight and what are we underweight? Because this will matter. If you look at dark blue and light blue in the middle stacked bar chart, we are 41% industrial, 39% multifamily. So put those two together, about 80% industrial multifamily. The average for the Odyssey benchmark is about 65%. You can see that in the corresponding bar right next to it. So we're a slight overweight to industrial multifamily property types that have done quite well in recent years, and we think continue to have a positive trajectory as we look forward the next 3 and 5 years. We feel really good about that overweight position to those sectors. Green is retail. You'll see our 11% retail and the Odyssey, the benchmark, 11%. So it looks like at face value, we're just exactly equal with the benchmark. When you look at the type of retail we own, the only retail we own is grocery anchored neighborhood centers. So we don't own any malls. We don't own any of the big power centers. We don't own like New York City high street retail like Cartier and all these things. We just own really conservative, your top grocers in certain markets, a Publix in Florida, an H-E-B in Texas, Whole Foods in Boston. If you're in these markets, you know what the top grocer is. We own those types of centers, really strong cash flow, really good performance, and very accretive to the fund's returns overall. So we like that overweight that we have to grocery retail compared to our competitive set. Underweight office. So we're only 5% office. The average is about 16. And so we have a lot of underweight to property types that are, even though office is turning the corner a little bit, still very challenged. And you need a lot of capital to service office assets that you don't need for industrial multifamily and grocery retail. And then the last piece in yellow you'll see in the top of this is that alternative bucket where you can kind of invest across a lot of different alternative strategies. For us at the moment, we're playing the alternative space by way of a data center investment that we have in Northern Virginia. It's a development deal that we've undertook about a year ago. It's leased already to one of the top 5 hyperscalers in the world. So really credit lease with durable, predictable cash flow. And we really like that, that type of investment for this fund. Now, having said that, we are not planning to expand that allocation significantly beyond what we currently have. We like that investment. It's done its job at 4 or 5%, but I'm not here to tell you that's going to be 15 or 20% in a year. It's not. But we like that one investment. And the goal here is, again, move into where you think the returns are coming from in the future, and throwing overboard returns or assets that you think are not going to be competitive, even if they have worked well in the past. The last thing I'll talk about regionally, the markets we're invested in. You'll see this here on the stacked bar chart to the right. It's not just important what property types, it's also the markets. Each of these things are growing at different clips. The biggest distinction we have compared to the overall core universe is in dark blue at the bottom. You'll see 44% of our fund is invested in the South. And the South, I don't have to tell you all, but you see the growth patterns, population migration, company relocation, GDP data. The South is really outperforming relative to the vast majority of the country. And so when we have a 44% of our fund invested in the South, and you can see the average core fund has about 22%, we're 2 times the weighting to the South. And that comes at the expense of being underweight across the rest of the country. So really trying to stack the fund up in property types and markets that we think are positioned for future growth, not what might have worked 5, 10, 15 years ago. But that's the job of these funds, is to continue to move these over time. Maybe just with, I'm at the 10-minute mark, I'm cognizant of time here. I want to hit slide 19, which is the PERS commitment slide in the fund. And as I mentioned at the outset, it's been a relatively brief tenure for now. I mean, and you'll see, so the bar charts to the right, we'll start there. If you see on slide 19, basically show the 5 quarters since PERS's initial commitment. And even in those 5 quarters, there's been capital added over time. So it's a little bit of a unique year, I would say, because it's only been about a year. And even during that year, we've had different capital flows from PERS, which we obviously appreciate. You can see the different quarters there, PERS commitment, what the percentage of return would have been compared to the Odyssey. Odyssey is the benchmark. Each individual quarter, the numbers kind of vary a little bit. But the since inception number, which is really just going back 5 quarters, the fund has outperformed on PERS behalf compared to the Odyssey index, which we're obviously happy about, even though it's only been a relatively short period of time. These types of investments, our investors tend to be looking at these as longer term holds. So our goal would be to come back as often as you'd have us and continue to show, stack up more and more kind of outperformance over years and years and years to get to kind of a return profile that you'd feel really good about over the longer period of time. Maybe just on returns, one thing I'll hit before is also we're just about to wrap up our Q2 returns. We're in the process of finalizing Q2 returns. I can't mention specifically because it hasn't final, but Q2 is going to be a very good quarter for this fund. We are seeing significant appreciation in that grocery retail portfolio I mentioned. So we're seeing a lot of appreciation there. We're seeing appreciation in our industrial portfolio. So that's going to be very complementary for the fund in Q2. And we saw more appreciation as well in our data center investment that we made as well. So those three things alone are powering some significant appreciation to the fund. And with the income that the fund generates, we're expecting Q2 to be a very good performing quarter. And I don't have a sense on what the benchmark Odyssey will come in at, but I'd bet the over that will outperform by a good margin in Q2. But we'll find out the official details of the Odyssey right about middle of July. So one last thing I'll talk about is slide 21, and then I'll maybe pause for questions. Slide 21 is really to us the more kind of an important slide. It's returns historically, but it's, you know, we all look at quarterly returns, we all look at annual returns, but for core open-end diversified funds, we really think the measuring stick for these funds is kind of these rolling 3-year and rolling even 5-year increments. Because most investors don't get into these funds just for 1 or 2 or 3 quarters. It just takes too much time, effort. They're in it for a 5, 7, or 10-year look. So the rolling 3 and rolling 5-year view allows investors to see, it answers the question of, is the strategy of the fund being consistently supported by the returns of the fund? You know, in any one quarter or even 1 year, you might have some volatility that's good or bad. But rolling 3, as you look at all the rolling look back 3-year timeframes or even the rolling 5 years, it smooths out that volatility that 1 quarter or 1 year might have given you, again, for better or worse. And it really answers that question. So for us, this slide is looking back at all rolling 3-year increments since the fund's inception. All right, and so dark blue is our fund, CPF, net returns. And light blue is the Odyssey, the benchmark's net returns. Again, every single look back period, all rolling 3-year timeframes. Below that is in green the level of outperformance that we had compared to the benchmark. So what you see basically at a high level is the absolute numbers change because we've lived through a lot. Do you think about the pandemic, the debt hiking cycle? The absolute numbers definitely shift around, that without a doubt. But what didn't change is our ability to outperform during all the rolling 3-year timeframes. And what's kind of shown in the middle in the quartile ranking is that when you look at those numbers compared to the Odyssey benchmark, of which there's 25 funds, and we're one of them, we're top quartile in terms of the performance that we've been able to generate. And so for us, that's really, again, the measuring stick, because these open-end core funds, you're moving slowly at some levels over time, and you want to see it as the strategy of how you're moving consistently being supported by way of the returns of the fund. So maybe with all that said, we're coming just on the 15-minute mark. I'll take a pause here and see if there's any questions.
Okay, question, yes, go ahead.
Jake, you mentioned liking that one data center specifically, but not looking to add to that too much. What about the other alternative sectors? Are you looking to expand your footprint there? I'm thinking student housing, self-storage, stuff like that.
Yeah, absolutely. And I think this is definitely an area that all fund managers, whether you want to invest or not, you have to monitor and evaluate. And so as it comes to the alternative sectors, we do like self-storage. Right now, I'd say storage has had a little bit, the last couple of years, a little bit of a softer go, broadly speaking. I mean, certain assets might be different, but broadly speaking, storage has had a little bit of a softer go of it. So storage is one I think you could see us investing in the future. I think there's 2 questions, though, that you got to ask on our side of the table. One, do you have conviction in the space? Okay, whether it's seniors housing, student housing, storage, data centers, do you have conviction in the space? Second question, which doesn't get asked as often, but needs to by folks on our side, is can we, the manager, provide some sort of access or execution in that space to the benefit of you all? Because if all we're doing is just saying, hey, we're going to call up some shop and form a joint venture, have them operate it for us, source deals for us, operate us, and pay them a fee for us, just to put a pin on the map, I don't know that we're really adding you all any value. And so we take that second part of the question even just as importantly as the first. One is, do you have a good thesis on the space? If so, how are you going to access it and operate it? And so for us, these 2 things come into play. And so you don't see us as a firm historically go out and blanket the space by investing in the different, fads of the day, or investing across all 32 flavors of ice cream. We try to stick to our knitting, but we also play to our strengths and expand into the markets, data centers, storage, things of that nature that we think have a go forward and where we can actually provide some expertise.
Others, yes, go ahead.
Jake, I want to say thank you for saying the word y'all. I heard that you say that a few times. I was expecting a you guys. Or
You guys?
Yeah.
Oh.
So I appreciate you kind of conforming to this other.
No,
saying y'all. Second thing is, there's been a lot of noise here recently, or not a lot of noise, but there's been noise here recently that interest rates, they may not be going down. They actually may pop up. When you look at where the fund is positioned now, where do you see where the pipeline may take you, and how are you looking at this opportunity defensively, if that may be the case?
Yeah, no, it's a fair point, Jason. Interest rates are for all asset classes, but real estate is certainly not immune to interest rate movement. When it goes up, short story, it tends to hurt real estate. When it goes down, it tends to help real estate. Now, what have we done? One is which we delevered the fund. So I mentioned we're 23%. That is among the lowest of the Odyssey Index. And that's not by accident. That's by design. Because as you're entering these stormy, kind of choppy waters, you want to be really careful about not dialing up your leverage at a time when interest rate could be high and volatile. So we've kind of prepared a little bit by delevering. Okay, so that's one way. Second thing to think about is the portfolio construction. Okay, so especially if you're in a higher interest rate environment because of inflation being one of the driving factors of that, you want to look at the property types you're invested in. So industrial, without getting too myopic, industrial assets are net leased assets, meaning the tenant pays all the costs to operate the premises. And so the landlord receives just a net rent. And that is inflation protection for us because we don't have to operate the facility for the. If you look at multifamily, one of the benefits of multifamily is they're short-term leases. So you're able to reset those rents in theory to account for inflation in these markets. Grocery anchored, same thing, kind of like that industrial. It's a net lease kind of execution. So we think the portfolio is built well to withstand it, but it doesn't make it immune from it. And I don't want to pretend that somehow we're immune from interest rate rises. We're not. And if interest rates were to rise, you would expect to see a corresponding somewhat of a decrease in valuations across real estate. The only way to offset that is to expect the cash flows of the real estate to increase at a higher rate than you previously expected. That would be an offsetting force to the higher interest rate environment if you find yourself in that. So I don't want to minimize it. It's definitely something we take very serious, but I think the portfolio is built to withstand on a relative basis.
So you feel that the fund is in a defensive position to withstand that?
Absolutely, both in terms of low LTV and the construction of the portfolio. It's as well suited for a higher interest rate environment as any fund could be. But it's like anytime the hurricane, if it's a storm comes, you still got to get through it. You know what I mean? And so we feel good about it, but it's not an environment we'd love to sort of live through for a long period of time.
We don't want to either.
Yeah, it's the same.
Yeah. Thank you all. Yeah.
Other questions? I was interested in Publix. You mentioned, do y'all build the facility, or what is your relationship with Publix and the grocery stores?
Yeah. For the most part, we don't build new Publix stores.
Okay.
We tend to buy them from folks who have previously owned them for different reasons and are looking to sell. That's the vast majority of our retail holdings are buying it second generation from somebody who might have previously owned it.
Okay.
In the course of our firm, Tom mentioned we have a 40-year history, particularly in our value add business. That's where we would typically do more development. And in those instances, we might have built for Publix over the years. Yeah.
Okay. I was just wondering, have you ever had a Subway from Publix? I'm telling you, it's the best Subway. You guys by far.
Oh, Publix subs are the they're the top.
The
they're the top.
subs.
Publix subs.
It is a hidden secret of sub. If you like sub sandwiches,
those are the ones.
Go in the grocery store today. That's all I can say.
Those are the.
I'm a fountain of worthless knowledge, so that's whatever y'all need to know. Any other questions?
I do want to make one more statement. Tom doesn't get to come in very often, but I'll also say Tom works with us on our relationship with the value add managers.
Correct.
And value add real estate TA is our longest, highest performing value add real estate fund that we carry. And Tom, thank you for your relationship there as well.
Well, thank you. We appreciate the support. It's been a great relationship.
Thank y'all for coming. Keep up the good work here.
Thank you.
Come back to visit.
Thank you all.
Anytime. Thank you.
Good afternoon. We want to welcome you here. We do have your materials, so we'll follow along. You tell us what page you're on. We'll try to find the number you're talking about.
All right.
And then you have been reminded of our time constraints, so we'll trust you to take what you need out of that. So I'm going to turn it over to you all and let you go ahead.
All right. Well, thank you so much for having us here today. We appreciate the invitation. I just want to make a couple brief comments before we do the portfolio updates. First, I want to say thank you very much for your relationship over the many years that we've had it. We appreciate the opportunity and to be a steward of your investment in real estate, one of many. Before we dive in, I wanted to take a quick moment just to mention a couple things. I know you probably heard much about the real estate markets today, so I won't say too much there. I did want to give you a brief organizational update. Matt Johnson, who has served as the head of our business, has departed UBS. We wanted to be really transparent about the transition. His responsibilities have been consolidated under our CIO, Larissa Belova. And then he had a number of, I would say, operational functions that sort of fell under his purview. And most of those have been centralized within the broader bank, really just strengthening our infrastructure and capabilities. And we're very confident in the team we've got here and the continuity of our commitment to you. Today's agenda, you'll hear updates on both the Trumbull Property Fund, the Trumbull Property Growth and Income Fund. You'll hear a little bit of a refresher on what the strategies are, the performance, a little bit of outlook, and some investment activity. And I'm pleased to introduce to you, I've got Hussein Hassan on my right, who manages the Trumbull Property Fund. And to his right, I've got Eddie Maxari, who manages the Trumbull Property Growth and Income Fund. So with that, I will hand it over to Hussein for an update on the Trumbull Property Fund.
Thank you, Julie. Good afternoon, everyone. My name is Hussein. I'm a portfolio manager on our Trumbull Property Fund. Pleased to be here with you today. As Julie mentioned, thank you for being a longtime partner with us and stewarding your investment in the real estate space. Been with us since 2003. That certainly does not go overlooked here. And I'm pleased to give you an update on your investment today. Starting on the TPF snapshot, which might be page 16 in your books there. TPF is a core open-end real estate fund. We've been in existence for over 40 years now. It's just under $13 billion of gross asset value across 111 investments, which is about 160 properties across the country. This quarter, we hit a very important milestone, 3 consecutive years of outperformance relative to our Odyssey benchmark. Our outperformance has been deliberate and thoughtful, and the direct result of how we've repositioned the fund after a number of years of challenging performance. And this repositioning culminates in the sale of our non-strategic asset pool, which we've reported on in the past. That's over 40 assets that we put on an accelerated disposition plan and helped adjust our allocations and better our asset selection. The fund has also been transformed from majority retail and office to being almost 80% allocated to apartments and industrial sectors that we have high conviction in, and with an additional 8% in necessity retail. We're also adding new specialty sectors that are going to drive outperformance for the fund, and it's going to provide diversification, durability of income, and we're going to be taking advantage of non-cyclical demand drivers within the market, so positioning TPF within the greatest space of demand. And we think that this is going to help contribute to outperformance for TPF on a go-forward basis. From an operating standpoint, the portfolio continues to perform well. We're 91% leased across the board. Demand continues to be resilient in our high conviction sectors. Supply, you may have heard today, has been resilient, but then it's actually been declining quite quickly now. And with limited new supply coming online, this should really benefit our existing portfolio and our ability to grow rents on a go-forward basis. Lastly, on page 16, the fund has a very attractive debt position. We're approximately 23% leverage, and that's compared to the benchmark of about 27%. That gives us significant capacity to grow our leverage over time, and we can be patient and then activate that leverage bucket when we need to make accretive new investments and drive further performance for the fund. I'd like to talk about our portfolio construction next on the following page. And our portfolio construction and our approach to the sectors is really based on a data-driven approach. We have a new head of research, and his name is Norman Niemer. He comes to us with a data science background, has helped us develop a new set of tools that think about sector and market positioning. And we want to be on our front foot here. We want to be proactive about these allocations, not reactive. We want to be in the sectors and in the markets where we are going to find the best risk-adjusted returns here. And I believe that UBS is really investing in significant technology, including machine learning and AI, that puts us on the cutting edge of this to generate insights from the data that we have from our 40 years of operating history. So roughly 91% of the fund is in our highest conviction sectors. And so as we thought about our repositioning, first and foremost, we need to get our allocations right. And that's what we've spent the past number of years doing. But the next phase, and I'll talk about this a little bit later, is going to be much more granular and intense, with an intense focus on individual asset selection and asset performance. So in terms of positioning, I'd like to call your attention to the chart in the top right-hand corner of the page. The portfolio, this has our allocations here, just going sector by sector. Within the apartment space, the portfolio is 43% allocated to apartments. That's an overweight relative to the Odyssey benchmark. We really like that positioning. We find a lot of resilience within the apartment sector in terms of the ability to grow rents, the ability to be a little bit more inflation hedged as well, given the shorter term nature of those leases. And that product that we're invested in is in suburban garden style apartment properties, typically in good school districts. And so our current positioning is 43%. Our target is 35%. We have a little bit of headroom to sell out of that sector for assets that we don't think are going to contribute to long-term outperformance. But again, apartments are going to be our core, stable workhorse for the fund. On the industrial side, we're about 35% allocated to this sector. The portfolio is diversified across the country by building type and by size. Our average warehouse size is 240,000 square feet, which I think is a sweet spot in today's market. It gives us the exposure to smaller infill last mile facilities, along with larger regional distribution hubs. The middle section, the specialty sectors, this is one of the more exciting areas of TPF these days. We're currently 6%. We're looking to grow that to about 15% of the fund over the next 2 to 3 years. And when I say specialty, I'm talking about self-storage, industrial outdoor storage, seniors housing, life science. And so sectors that are going to require a little bit more of a specialized knowledge base and operating capability here. But I think we're poised to execute well in those sectors because given our scale, well, both UBS and TPF's sort of size and scale, we're able to attract some of the best operating partners within that space to be able to execute within those sectors. And so TPF brings the capital and scale, and our partners bring the asset level execution and deal sourcing that are going to allow us to get to that 15% target and drive further accretive outperformance for the fund. On the retail side, we're about 8% allocated to that sector. Our target's 10%. Our assets are composed of dominant community shopping centers, often with grocers as anchors, at main and main locations in high income demographic areas. Our retail portfolio is a smaller part of the fund today, but it's been really a strong contributor to our performance over the past couple of years. On the office side, we're underweight relative to the benchmark. We're about 9%. Our target's going to be 5% of the fund, or meaningfully less than the Odyssey benchmark. We're going to continue to sell out of that portfolio. We have a number of dispositions planned for this year, particularly in San Francisco and in New York, where we're hoping to capitalize on the exuberance and the strength of both those markets. And overall, though, office isn't a core fit for our portfolio, given its capital intensity and lack of durable income. Let's turn to performance next. On the next two slides here, we've seen a repositioning or a transformation of TPF and the real estate asset class going from negative returns to positive returns. TPF has now outperformed over the 1, 2, and 3 year time periods by a meaningful margin, which reflects our right allocation calls, and I think our improved selection calls as well. On a go-forward basis, we'll have to be very focused on asset selection and individual asset performance. And so we're going to be thinking about how do we drive asset management harder? How are we going to drive net operating income growth? That's through leasing activity, rent growth, capital expenditure. Very, very thoughtful about that. Over the past year, and really actually just in April, we just completed our annual insurance renewal. And through that renewal, it came back flat. And that's actually quite meaningful, where in past years we've seen for us and for the benchmark 3, 5, 10% increases. And so when we have a large non-controllable expense coming back flat through our active management of that, that's a great outcome for our ability to grow net operating income. On the following two slides, we look at the past year of where performance has come from. Net operating income growth on slide 20. On the bottom chart on slide 21, it's the second contributor to our outperformance has been leverage. We're in a much better position than the benchmark again, and that's contributed about 70 basis points of outperformance there. On the following page, where is return going to come from on a go-forward basis? That's going to come from our ability to drive net operating income growth at the underlying set of assets. And so we have a breakout here. I want to certainly leave Eddie some time to speak here, but I'm happy to go into any details on this slide during the Q&A section. Touching on liquidity, and which is a priority for the fund. We certainly have a large redemption pool, but that's meaningfully come down over the past number of years. And just year to date, I think we're looking at about 1.3 billion of rescission activity from investors. So as performance has turned for TPF, as investors look at it on a historical basis, but also on a go-forward basis, they're saying, hey, I think TPF is a much better position than it's been. I don't need liquidity from this vehicle. I'm going to make a rescission request to rescind my redemption request. And so we've had meaningful activity there. The pool has come down. We've tried to, to bring down the pool. In addition, we've, led it with asset sales, or the traditional way of selling assets to provide liquidity. We've also taken a multi-pronged approach to be very creative with the fee optimization program, but also helping facilitate a secondary process, which I think was very well received in the marketplace. Touching on, we have sales activity and then acquisition activity. I would like to just touch on acquisition activity. This is one of the new growth areas for TPF. I would say our platform has gone back on offense, and net investment activity is growing. Our investments are focused on the specialty sectors, where we, I think, see attractive supply-demand fundamentals, and where we're partnering with best-in-class operators. So we have a couple case studies in here. I won't cover it, but happy to answer questions on that. But we partnered with Welltower. They're the largest operator of senior care facilities in the United States, with a demonstrable track record of growing NOIs. So partnering with them to do seniors housing. We're partnering with Extra Space. They're the largest REIT within the self-storage space. And they're quite compelling in it. They're granularity of their asset management along with granularity of their data science capabilities to be able to price rents, to manage expenses, and manage personnel at properties that I find super compelling. I'd just like to wrap up on leverage. Our leverage strategy, again, we're under leveraged relative to the benchmark, and that has been a positive contributor to our outperformance. I think that also leaves us in a really strong position today that as we think about driving additional accretive performance, and we'll borrow dollars to then make new investments for Trumbull Property Fund, which will be good. And then I think about our next 3 years of debt maturities. Everything's manageable here. Our largest sort of year here is in 2028. That's on a pool of apartment assets out of our Fannie Mae credit facility. Those are 50% levered apartment properties, and I would say none of that sort of keeps me up at night. I'll give the rest of my time to Eddie here.
Awesome. I know I'm going last, and I'll sure to make it light and sweet. But my name is Eddie Maxari. I've been with the firm for 12 years, and I'm one of the portfolio managers on the Trumbull TPG, Trumbull Growth and Income Fund. My goal today is a quick overview of the fund, hit on some performance to date, as well as kind of give you guys a clear idea of where our position is as of date and where we're kind of targeting in the future, and at the same time kind of explain and provide some detail on some of the stuff that we're working on in efforts of us hitting that target. I would say that if you guys don't mind, turn to page 52. TPG is the smaller fund, as you probably might have heard many others today. We're around 931 million, just under $1 billion. Our net assets are around 525 million. The fund has 20 investments. Of the 20 investments, 15 are with third-party mortgages. And then out of those 20, 18 of them are joint ventures. And then the fund itself, it is 42.9% leverage. And leverage comes very important, as you probably have heard all day today, but at the same time, when markets are struggling, it does impact our performance. And a fund like this has underperformed in the 1 year and 3 years. With that being said, I would like to turn over to page 53, where we provide our annual returns. Although the underperformance in 2023 and 2024 has been due to various market conditions, as mentioned, debt being a part of it, we have had some struggling assets that we've worked through. And we've positioned ourselves that we think that as the market kind of rebounds, we will be able to capture that outperformance going forward. To say that in 2025 and going into 2026, the fund did produce its 7th consecutive positive return, which is great news to know as we're trending with the market. Specifically, although the fund underperformed Odyssey in the current quarter by 76 basis points, I do want to know that since inception, the fund has outperformed Odyssey 10 out of the 15 years. With that being said, I would also like to kind of give a quick overview on the fund positioning. As mentioned, levered we have struggled due to levered a little bit, but at the same time, understanding that our current position and the current allocations that we do have, a small fund such as TPG will be able to capture, again, as mentioned, the rebounding. We are currently allocated 71% to residential industrial. We like that. That is the target that we're kind of seeking going forward. We have a low exposure to office. Our office exposure is only 4%. And we do have a good exposure to this so-called specialty sector. So this is a new bucket you guys might have heard of, anything from self-storage to senior housing to IOS, which is the outdoor storage, industrial outdoor storage. To say all that, we like our positioning. We are kind of, as we go through the cycle, expecting to execute on that. Our leverage is 43%. Our target is 50%. So yes, we are high leverage, but as opportunity comes in front of us, we are able to pull that leverage to kind of execute on new investments. The fund itself does target 100% partnerships. So similar to what Hussein mentioned, we do want to team up with the best of the best in specific sectors. As such, we kind of seek and we kind of push towards maintaining relationships and being on the front end of having strong relationships going forward. Lastly, on page 55, we talk about the life cycle diversification. The fund has a target of 60 and 40, meaning that it likes stabilized 60%, and then 40% is the value add aspect of it. Currently, we meet that target, but as we see liquidity and the market kind of rebounding and money coming back into the market, our strategy is to liquidate a lot of our stabilized asset. So we have that 60% pool. Our goal is to execute on some dispositions. We have done so in the beginning part of the year. We have 4 assets out in the market that we're working through right now. And then our goal is to capitalize on that liquidity and then redeploy that money into newer accretive sectors. With that being said, we are actually, as we talk, closing on a new iOS deal that was supposed to close today. So again, that's just an example of how we're liquidating our executing on our strategy, make sure we invest into value add investments, stabilize them by utilizing our partners, as well as once we achieve that stabilization, cycle through it and kind of capture the timing of everything. Lastly, I wanted to talk briefly as far as our finance plans. As mentioned, we do have cash at hand to make new investments, and we will continue to monitor our cash with interest rates being the way that they are and being so unpredictable. But at the same time, we have executed on all our finance responsibilities. And for 2026, we actually have 3 loans that are coming up due. 2 of them, we are expecting to use our extension options that we have on them. One of them, one of our assets, which is an industrial asset out of California, we expect to pay that loan off. And this is an example where we don't believe that it currently is the right time to sell this asset. So paying back the debt, holding on to it, stabilizing, then executing out of it is the strategy behind it. So lastly, and I know I've been rushing a little bit, so I apologize. My last comments is regards to we do have a redemption queue. It is around 176 million. Our goal has been to fund redemptions throughout the year, so we do have a target of fulfilling that redemption. But at the same time, we have been very cautious to make sure that we have the responsibility of making sure we do right by all our investors, meaning that we continue to execute on opportunity, but at the same time, meet our requirements from a redemption perspective. So if you guys have any questions, would love to deep dive on anything you guys might have.
Questions? Board members or staff? Go ahead, Jason.
Julie or Eddie, can y'all speak to the conversation concerning the fee savings on TPG?
Let me take over. So absolutely. So Jason, as you're aware of, and as I mentioned, we have our performance has struggled, and a fund like this is expected to have a difficult performance during the down cycle. As such, we've heard feedback from investors, and as well as a team, we understood that the pain kind of needs to be shared. And what I mean by that was we proposed, we got approved, and we send out a fee reduction to all of our investors. It's not something that people can opt in or opt out. It is, again, is based on the tier structure of every single investor. We have given them a break until we meet our outperformance. So that's our way of saying that, hey, we're part of, this kind of strategy and this fund just as much as you guys are. So we want to kind of feel the pain with it. So we have lowered our fees on it. It is ongoing until we meet that target. It is something that we've shared with you, and there's, again, our goal is to make sure that we're, 1, transparent, but 2, is that, if given the opportunity to continue to operate as we are, we're expected to meet our target as we're presenting. So does that help a little bit?
Yeah, thank you.
Yes.
Yeah, quick question for Hussein on TPF. You mentioned a disposition plan for some of your office properties to get you closer to your target. Who are you seeing out there as the buyers today? Is it other Odyssey funds? Is it who's buying these office properties?
It's the largest buyer is probably private family office buyers. The second largest buyers are more alternative or hedge fund sort of groups. And so we have out in the market right now 455 Market. It's our San Francisco office building. We've marketed it for a number of months, called for offers, and have selected a buyer now. we're working through that process still, so we're a number of months away from closing. But the buyer profile on that is a San Francisco local operator that's teamed up with two institutional funds, one being a hedge fund, one being an alternative asset sort of manager, to then partner to purchase our building. And so I think the core money there, the Odyssey funds are not active buyers within that space, but more of these alternative groups. In New York, we're marketing our New York City office building there at 120 Broadway, and it's a similar sort of buyer profile there.
I have a question about your specialty area and I guess I'm going to call it your open storage space, logistics and that sort of thing. I have a hard time in my mind figuring out how you make that profitable, because you're not building up. You can't go out. You got to put a fence around. I mean, how does that kind of work in your thought process of who uses it and how you choose the customers you have there?
Certainly. So in real estate, there's two areas of value. There's value in the land, and then there's value in the building. And so despite not having a building there, there's value in the land. And a tenant finds, a customer or a tenant there finds value in the land because they need to store things. The space is called industrial outdoor storage. And so they store things there from, in one of our sites that's in one of our separate accounts. It's leased to Frontier Communications. They're a telecom company, and so they park their trucks, their fleet of trucks on the sites that fleet then goes out and services telecom lines within Southern California from the three sites that are one of our separate account owns. In a couple of TPF investments, we have sites where and I would say we were doing industrial outdoor storage before it was cool too. That we purchased a long time ago, and that it's leased to a chemical distributor, and so they do a lot of that transferring sort of outdoors. They need this site is served by 2 rail lines to it, and then they do a lot of distribution from there.
Do you allow, now that's the logistics portion, I'm assuming that, do you allow people to put small structures on there in which to store things to do these logistics, or do they have to be on trailers, or, how is it just free storage? How does that work?
Typically,
and the volatile or chemical kinds of things that may be stored there.
Certainly. So in terms of the volatile and chemical, it certainly needs to be approved by the city.
Oh, okay.
And so everything needs to be done in accordance with zoning and zoning laws.
Okay.
In terms of what's stored there and do we allow buildings being built, typically these sites actually have sometimes have buildings on them existing. It's a small building though, and the primary purpose is outdoor storage. So what other examples, sometimes they're used for construction tenants.
Mm-hmm.
So it's a lay down yard. So they put outdoor lumber there, they put materials there, they put cherry pickers, so the little machines that you might see a public employee worker working up on a telephone line.
Sure.
Working. And
yeah, so we're actually closing on a deal today
Okay.
in New Jersey. As Hussein mentioned, a lot of these, they're not just a plot of land. We have a roofing company. So now this roofing company has done very well. They have expanded their business. And within the site, because the site is approved to have things like the chemical aspect of it, they can actually build their own shingles, they can repair. So they can use the industrial side of things to repair their trucks and kind of utilize, they have a mechanic on there, but at the same time, they can have things on the side, which again, you can not only do storage, but they can produce little things on there. And again, it's not that we restrict it, it's zoning. It goes back to zoning. These sites and these plants and the value that we're investing into it is that it has gotten that special permit. So to say that next door somebody else can do the same thing, it cannot, right? Because the zoning has been assigned for that specific operations, and the tenant itself has to obtain all the appropriate approvals for it. They can go from, again, running their business as simply as storing stuff out there, but also producing stuff out it and utilizing it for their business.
Makes sense to me.
Yeah.
I mean, everybody's got a storage room somewhere, and these businesses are just like they keep, never mind. I get it now. I get it now.
I relate to you. I also have a storage unit
Yeah.
and we invest in self-storage properties and I've experiencing the rent growth that we're passing on to our tenants here and it's profitable for your investments.
I understand. Okay, thank you. Any other questions before we? I want to thank y'all for coming and sharing with us today about these two funds. Appreciate it so much. Hope you enjoyed your visit, and we certainly have learned today. Keep up the good work for us. Thank you.
Thanks. Thank you.
I'll highlight that.
Yes, sir.
That you would like to talk about?
Oh, yeah, I got.
I would like to
plethora of
close.
Stories we can go through here this afternoon if you'd like to.
Right.